from a CIBC perspective, we do expect the dollar to gradually diminish value through the course of the next few weeks and months. I think the Fed narrative is certainly an uncertain one in the context of those long and variable lags in terms of policy. I think the market is possibly getting ahead of itself in terms of pricing cuts, but nevertheless, I think it is going to be the case that the dollar narrative is going to be less constructive through the course of 2023 than we've seen through 2022. And in the context and the prism of the banking sector uncertainties, I think the upcoming balance sheet data will be hugely interesting because, of course, we're seeing those balance sheets between the Fed and ECB in particular moving in opposite directions now.
Jeremy, there's a commodity heritage at CIBC of Toronto. That includes, obviously, Canadian dollar. Maybe it includes Australia as well. And it all redounds back to China in this new theme that maybe China's not rebounding like it is. Across all of the CIBC platform, can you suggest China can show growth or less growth? And what does it mean for the commodity complex currencies?
Well, I think first of all, you've got to remember how the growth composition of China is going to be formed going forward, because, of course, we have to recognize and realize that if we are going to see China getting anywhere near that 5% growth target that has now been put forward by the National People's Congress, it's probably going to be more driven by domestic rather than external demand. But clearly, if we are going to see domestic demand rising, then we are going to see some demand or impact on the commodity spectrum. So things like iron ore and other associated commodities will remain relatively well supported. So I think it is the case that there are clearly challenges in terms of the reopening narrative. It's not going to be a smooth transition. We are going to see many bumps in the road, and I think that's going to be the reality. But I think in the context of the China growth story, I think it does provide some constructivity to the commodity spectrum, and to an extent that will also play out in terms of the way that the commodity currencies perform as a consequence.
Jeremy, I love speaking with currency strategists because you always have to come up to be an expert in something that is the topic du jour, and it sort of feels like a very much of a kinship to what we do every day. And I'm wondering right now how much you're becoming an expert in all things banks and understanding the depths of the recent fissures we've seen.
Absolutely. That is the nature of this role. You move from virologist to military strategist to now to banking analyst. And in a sense, I think there is an obvious question marks regarding the resilience and all the primacy of the banking sector. I think we're also looking to try and understand how the transition in terms of the deposit bases will have an impact in terms of the broader corporate lending strategies. And of course, after the AT1 debacle in terms of Credit Suisse last week, we're also thinking about the primacy and the hierarchy in terms of the debt profile. So, there are a number of moving parts here. Clearly, I think markets are feeling relatively relieved in the context of the last 24, 48 hours that we haven't seen further concerns playing out. Is it too early to sound the siren of risks are over? I think it probably is. But I think as long as we don't see sort of another sort of systemic crisis playing out, then I think we will see these sort of immediate related concerns and underlying sort of flight to safety risks gradually diminishing. And we can come back to the realization that we're probably getting pretty close in most instances to the end of these tightening cycles. And I think that's the subtext that comes out of this whole crisis, is that Fed terminal rates near 6%, which was, of course, the sort of market discussion after Chair Powell speaking 2-3 weeks ago, I think have been consigned to history.
So how does that play into a currency call? Is that the reason why we're seeing dollar weakness with a persistence that has surprised so many people?
Yeah, I think that is the case. I think we had clearly we had Chair Powell reopening that sort of narrative regarding 50 basis points for the most recent Fed and also a higher terminal rate. But I think that was always going to be a little bit of a step too far in our opinion. So we went into this crisis assuming that we were going to see 50 basis points, 25 at the last meeting, and probably another 25 to come. And we still feel that's probably about right. But I think we are seeing, obviously, markets repricing the degree of Fed tightening. It's too early to say that the Fed should be cutting this year, but I think the recalibration in terms of the terminal rate in the US, I think, is relevant. Certainly in the context of where we're probably still going in the Eurozone, where I think there's probably at least another 50 basis points of tightening to come. So I think it's that sort of reorientation of terminal rates as a consequence of this crisis that has underlined the dollar narrative no longer looks quite so constructive. And I think we will continue to see investors looking for the diversification trade or moving back into those currencies which had been low yielding. And I think the big story that I think is going to be still relevant for this year is probably going to be the comeback in the yen.
Interesting. So you basically think that there is going to be a shift back to haven trades that perhaps haven't gotten bid up to the same kind of degree, which raises a question that we were talking about with Damian Sassower yesterday, which is at what point does the terminal rate matter, not just the pace, right? The higher yielding currencies, the higher rate hiking cycles of some of the emerging markets garnering a lot of flows. Now perhaps some people starting to wonder, okay, are those rates going to be punitive to the economic growth? You think that we're at that point?
I think we're getting pretty close to that now. So I think that's certainly something that I think is an ongoing discussion point. But I think also it's the whole sort of uncertainty regarding the sort of the fiscal backdrop, but also I think the monetary backdrop, but also I think the context of some degree of polarization from Japan, which I think is coming through, I think there is an sort of ensuing appetite amongst the sort of the fund manager community in terms of, in line with our view, that it probably is going to be the case that in this still relatively uncertain backdrop, with some degree of catch-up perhaps coming from the BOJ, that there is scope and will be scope for yen appreciation. And so the question is, how do you play that? And we would suggest there could be a number of ways of playing that across a number of currency pairs.
Jeremy, one final question. What flow dynamic or flow narrative keeps you up at night? You just mentioned BOJ, and I saw a really distressing note about what happens when YCC goes. What's the money flow, the dollar flow mystery I need to think about into 2024?
Well, I think the Japan one is probably the most interesting dynamic to consider. If we are going to see the domestic life companies keeping more money onshore, and so there's going to be less transition in terms of international markets, then I think that's going to be a relevant story. So I think if we do see this sort of adjustment in terms of YCC, so if we do see that the era heralding a degree of policy normalization, which I think is likely, probably perhaps early into the second half, but I think it is a likely scenario, then I think we will see less money flow coming out of Japan. I think we will see a stronger yen as a consequence of that, but also that has some implications for that flow through into the treasury space if we're going to see less of that international demand coming back into the US treasury.
Jeremy, thank you so much. Jeremy Stretch there of CIBC as well. Sorry for the coughing this morning, folks. A plague is here. Lisa's medically protected through it. And we're just getting through it. We're getting through it. It's been going around. John had it a couple weeks ago, and you're next.
Thanks.
We'll do that.
Appreciate that.
Our theme this morning is bond volatility. Even if you don't care, it matters for you in commodities, in Jeremy Stretch's currencies, and also in equities. Liz Ann Saunders, always at Schwab, out with a brilliant chart, really placing the uniqueness of the moment, bond volatility. And she says it's not going away. Do you agree with that within your reading?
Well, people think that it's not going away. It might come down as people get a clearer sense of whether we've hit the peak in terms of a terminal rate for the Fed funds. But I don't think people believe that we're going to enter this new regime of stasis in inflation. And that's the key. It's inflation volatility that's going to lead to the volatility in interest rates.
And critically, a whole new world after all, and we're not going back to what we've seen. Let's bring up the chart now. This is the Merrill Lynch Move Index, which was definitive 20 years ago, I'm going to say now, and of great use today. Lisa, we go back here, a solid 20s on radio. It's a lack of volatility. You know what happened in 07, 08, and then a relative lack of volatility, and up we go. I did a fancy moving average study on this, Lisa, and we're not back yet to the angst of 09.
But it's interesting to see that the bond volatility, this is the implied volatility in 10-year Treasury yields. That's actually what this is tracking based on derivatives.
Listen to you.
It's not actually matching with a lack of movement in the VIX, a lack of movement in the implied volatility in stocks. And that, I think, is what people have pointed to. Is the VIX broken? People will talk about that. But there's a larger issue of, if you don't have consistency in bonds, can you have consistencies in other risk assets that often are priced off of that bond yield?
Everybody's sitting at home, including me, going, Lisa, what are you talking about? Nobody cares. We're in money market funds. If I'm in a money market fund, do I care about bond volatility?
Yes, you do, because
Why?
if you're in a money market fund, let's say, and suddenly bonds sell off dramatically, okay, you might lose a little money, right? Because the rates go, because basically price down, yields up, right? But you could get more income. On the flip side, if you start to see rates go down dramatically, then all of a sudden you go back to risk assets looking better on a risk-adjusted process. We go back to that low-rate world and the playbook there. That's the issue that people are looking at, and the reason why people are bidding up risk assets.
I think our theme for tomorrow has got to be: do we go back to the nirvana we had? This, low rates for everything. I don't hear many people saying.
No one is saying that.
No one's saying that. Well, maybe that's a bad idea for Nirvana. Wednesday. Maybe we can do Tottenham and who the next coach. You think that's where Farrell went? Do you think he did a coach interview?
I think we should listen to Nirvana.
Okay. Well, yeah, we should.
As you are.
Futures at -6. Stay with us on radio and television. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Police in Nashville, Tennessee say the shooter who killed 3 children and 3 adults at a Christian elementary school may have been an ex-student. Audrey Hale was described as a 28-year-old white Nashville resident who was identified as transgender. Hale was shot dead by police. Did the Federal Reserve do enough to oversee Silicon Valley Bank, the lender that collapsed earlier this month? Well, that's what a group of Republican and Democratic senators want to know. They've sent a letter to Fed Chair Jerome Powell asking if the central bank exercised its full authority to supervise Silicon Valley Bank and other mid-sized banks. The head of the National Security Agency's cybersecurity arm says that popular video sharing app TikTok is China's Trojan horse. Rob Joyce told a conference in California that TikTok poses a long-term strategic concern. There have been calls to ban the app from the U.S. or for its parent, ByteDance, to sell it. A big structural change at Alibaba. The Chinese e-commerce giant is splitting its business into 6 main units, each of which will explore IPOs or fundraising when the time's right. The units will encompass e-commerce, media, and the cloud. And Adidas and Beyoncé reportedly have agreed to end their fashion partnership. According to the Wall Street Journal, that comes after years of weak sales for the performer's Ivy Park line of clothing. The Journal says sales fell 50% in 2022. Meanwhile, Adidas was paying Beyoncé about $20 million a year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I don't think we are at all in the place we were in 2007-8. We're in a very different place to then. But we have to be very vigilant. So if I give you the answer, I don't think there's a problem going forwards. I do not want to give you for a moment the idea that we are not very vigilant, because we are. We are in a period of very heightened, frankly, tension and alertness.
Andrew Bailey, Bank of England governor. Full disclosure, I'm a big fan. I've interviewed him a number of times, and he's just really somebody who's tangible, has his fingers into it, there's a belief here, folks, that Andrew Bailey probably has an operational integrity of what's going on at his central bank. Lisa, we've got to remember that he's the one who was hesitant to declare victory. He was Churchillian there a number of weeks ago on whatever the topic was.
There's also a distinction between the inflation that we're seeing over in the United Kingdom and what we're seeing in the U.S., driven more by some of the food and energy prices and rising and surprising to the upside, not seeming to have peaked just yet. And that's sort of a pressure that really causes perhaps more of a sort of two-sided argument for the Fed, for the central bank there.
We began the hour with Brammo folks with a really, really important idea, which this is not over, and yet we don't know where it's going to go. And we need to review the first guy that had to deal with this, whose name was Bailey. Governor Bailey had, I believe it was in October, this pension derivative. And the thing, Lisa, I would note is that was structured. I went back and actually looked at the literature as a marketing campaign. Was Silicon Valley Bank any different as a marketing campaign?
Which, the bigger question, what is the next shoe to drop, right? Are there other marketing campaigns that we're going to see in their full regalia once the tides roll out? Who's standing there naked, as Warren Buffett said? And how much are we starting to see that? And is it just the beginning, or are we seeing the brunt of it? And I think that that's one of the key questions as we look to what's the next shoe to drop? Are we done with this crisis? What will be the fallout?
Joining us now with Jenny Montgomery Scott is Christopher Marinac. He is in banking research, an important voice to speak to at this time. Let's just start with first principles in the moment. Christopher, is the crisis over?
I think we're getting to the end. The two troubled banks have been resolved, and I think now we see resolution from both Signature Bank last week and yesterday with First Citizens buying the Silicon Valley. So I think we have to get to the end of the quarter on Friday, but I feel like we are on the road to recovery, and I think when earnings are announced in a few weeks in mid-April, you're going to see much better results and much better deposit flows than most investors have understood the last few weeks.
I guess I've got to go to deposit flows right now. We're going to get more reporting on that. One of the themes out there is, well, at 5%, forgetting about bank crisis, money's going to move to money market funds. Do you agree?
Well, we've seen money market mutual funds move $250 billion the last 2 weeks, if you look at the Thursday reporting. So clearly there has been some movement. But I think in the big picture, Tom, there's, I think, a lot less deposit outflow in the system. It's only 4.5% if you look at the Fed data last Friday night. So it's more muted, and I think we've been normalizing deposits all along. It just has felt a lot worse the past few weeks.
I'm going to use the Jenny Montgomery Scott history here of Philadelphia, and you go out to traditional banking outside Philadelphia, and that's a place where it would be like anywhere in America. What I detect here is banking by marketing concept. When you talk to bankers who are like normal people, how do they feel about marketing concept-driven ideas intruding in this crisis on their normal banking?
Well, to most customers, they're looking for service. They're looking for more than just interest rate. If interest rate was the only thing, then I think we would have seen the bank deposit costs rise a lot faster the previous 4 or 5 quarters. It's been a very slow increase of deposit rates. I think we are going to see a meaningful impact and higher rates in Q1 and Q2, but in my opinion, it's a much more muted response. Customers want safety and surety, and they also want advice. So it's not always about interest rate.
That's the dog barking in the background, just in case you knew that. His name is Chipper.
I was
after
wondering.
Chipper Jones.
I was wondering if Chipper was having serious concerns
Chipper's
about
barking this morning.
He's having angst about the banking system. I am wondering.
The Braves have beat the Red Sox like 4 times in spring training, just so you know.
Thank you, Tom. Christopher, I am curious. There's this article by Mohamed El-Arian on Bloomberg Opinion. I keep going back to it because it really highlights this one aspect that people are honing in on. Even if we don't get some collapse in the financial system or another bank, there still is going to be a grinding, tightening, a sort of acceleration in how much some of these regional banks withdraw some of their credit. How much are you tracking that? How much do you believe that narrative?
Well, I think that credit always gets tightened in a crisis like this. We saw it in 2008 and 9. I think banks are going to be very discerning on the new loans they make. There's a lot of pipeline lending that was done in January and February, and I'm sure it became a lot tighter the last 3 weeks. So as we head into second and third quarter, I think new loans will be very much lower. And if anything, you're going to see much higher rates. I think one of the mysteries is that bank loan rates are going to be a lot higher. Banks are going to charge more for risk. And that actually is going to be a benefit, and it will offset some of the higher deposit rates that we see. But I think your question is a good one, and ultimately, credit is getting tighter.
So in other words, just to sort of frame this a little more starkly, could we see banks survive and even thrive, especially if they're consolidating business, at the same time that you see a more dramatic constriction in overall growth in the U.S.?
Well, I think dramatic might be the thing I would disagree with. I think it's going to be incrementally slower. Banks are still in the business of taking risk and making a discerning vote of confidence for their customers. I think leverage overall is so much lower today than it was 15 years ago. We see a lot of banks lending at 65 to 70 cents on the dollar when they used to lend on 90 to 100, and then the properties were coming down in value significantly. So we have less leverage in the system, and I think ultimately that's a key to what banks write off and their problems. So I think credit does get tighter for sure, but I don't think it's impossible. And I think if anything, banks are here for businesses that they wish to support. The key is the companies I think who are in good financial position can continue to move forward, and those who cannot will struggle. So, we do expect to see higher levels of credit issues as this year and next year unfold.
One of the big questions in the past couple of weeks is how much of a risk premium will be charged for some of the smaller and regional banks that could suffer deposit outflows in a way that the large banks just can't. How much is that going to be a lasting feature that basically the valuation story is going to be more disparate going forward of the behemoths versus the regionals?
I think the regionals and even the smaller community banks are going to do quite well. We think the deposit outflow theme has been incorrect. And I think as the data is shown for March 31st, you'll see a lot less outflows than folks have understood. I also think you're going to see a lot more clarity about the level of granularity of deposits at these smaller and mid-sized banks. So I actually think it's an opportunity for them to really open the kimono, give a lot more disclosure on deposits, the lack of deposit concentration. Right. That's going to be a huge difference when we see earnings come out in a few weeks.
Chris, the Wall Street Journal editorial lays out the first, whatever it is, the bank that went up 45% yesterday. They're taking out First Citizens. They're taking out SVB. How do the banks you follow, Chris Marinak, compete with a bank that has a massive support, gains, losses, deposit coverage, et cetera, deposit flight? How do other banks compete with someone so aided by the government of the United States of America?
Well, the reality is a lot of it comes down to individual relationships with bankers. And so you can have a lot of government aid for a given bank and a support at a moment in time, but it really doesn't have anything to do with the individual relationships and the advice that's given at banks. I think a lot of commercial businesses see a bank as a trusted advisor in addition to their attorney, in addition to their accountant. So I don't think that the government aid has much to do with that. I think, if anything, it's going to be an ongoing conversation about what those customers need and ultimately what they need to grow their business. I think businesses are slowing down as a result of this crisis this month, and that goes back to the credit tightening that is out there. I think there's a decision by many businesses to not increase their factories and increase their workers incrementally, just given what they've seen.
Hugely valuable. Christopher Marinak, thank you so much. Jenny Montgomery Scott there this morning on banking. I learned a lot there. I mean, there's a lot of flows here, but I just don't. Everything that tells me is that, you can argue about, is it this kind of bailout? Is it that kind of bailout? But we're bailing out these institutions instead of having them run out and go out of business. And I don't know what it means for the other banks.
We've redefined systemically important. That, I think, has been one takeaway. How do you determine which is a systemically important bank? Is it because it has concentration in a particular industry? Is it because it's going to spur fear and deposit outflows from other regional banks? How is a bank sort of determined to be big enough or important enough or relevant enough to trigger some sort of response from authorities that clearly have the willingness to come in?
Should we do a data check? It hasn't been hysterical. Like last week was hysterical. Futures -7, Dow futures -35. That yield 4.00%. I mean, that's come a long way, Lisa, in the last 48 hours.
Yeah, well, and to me, I just keep watching the bond volatility, the round trip that we keep taking. Still, though, yields materially lower than they were.
Should mention oil, West Texas Intermediate with a nice 2-day lift, well above $70, $72.97. Lisa Bramowitz and Tom Keene, John Farrell. We en route home, I believe. Amy Wu Silverman with us coming up. Good morning. This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This bank scare accelerates everything we were expecting this year.
It is really still a bit unknown exactly how deep this is going to be.
Markets are obviously trading on fear and panic.
Because the bond market just repriced itself overnight, we think that risk for the equity market is elevated now.
The Fed really sees a recession coming. They're going to do something.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Bramowitz, and Tom Keene. A Tuesday on radio and television amid crisis, maybe beyond crisis, staggering to the May 3rd meeting of the FOMC. The list of guests we had there, what a statement on our team working Saturday and Sunday to frame out beyond the crisis of last week. They did a great job yesterday in getting all those voices in.
There's the immediacy of it, what's happening, who's next, on the ground, what's the response, and then there's the long lags. How much is this basically the beginning of the lag effects taking hold and us seeing the consequence of the fastest rate hiking cycle in history?
But we're still at a higher interest rate regime. I mean, I haven't looked at the BTMM screen this morning, but SOFR, LIBOR, the stuff Ira Jersey looks at, and other bond experts, the fact is it's still elevated. We just heard from a bank analyst who says maybe deposits won't fly out the door like they have been. I see no way here we can say crisis over.
I would agree with that. I think most people would agree with that because it's not just the banking system. It's the broader sense of how this affects credit, how this affects people's dependency on the resilience of a market that has shown some real cracks. And I think that's what it really goes to. We're starting to see the consequences, the pain perhaps, that this rate hiking cycle has wrought. How much conviction do these central banks have to keep going in the face of inflation if these cracks continue?
Surveillance correction, I'm lying. It's a Tom King correction. I was wrong. Tom is wrong. And I thought these hearings this week were like, yeah, so what? And then all of a sudden, there's First Citizens, I believe it is, up 45%. And you know, it was just the market arbitrage and the government bailout they got, the sweet terms they got. I'm sorry, all of a sudden these hearings are, I was wrong, they matter.
Well, especially for the market, because
Hoarders going,
if you think about it, there were hedge funds and private equity firms that wanted to pick up some of the assets of Silicon Valley Bank that were rejected because it wasn't good politically, right? So this is definitely something where it needed to be the right kind of buyer, and then that right kind of buyer needed to have the protections in place to make sure that there wasn't going to be another deposit outflow. So again, there is an issue of what is the precedent we're setting? How does that play out over the longer term?
We've got, besides having a cough, we got a wonderful guest to start off the hour. So I'm going to race through the data and get to Lisa's important brief here. Futures -4. It's a churn with a little bit of lightness. The VIX 20.95 on the VIX. The big news this morning in the 2-year yield space, at least, has been focused on 4.02%, up ginormous since Friday. No other way to put it. Higher yield, lower note price. The 10-year 3.56%. Curve not giving me much information. The real yield 1.30% on the 10-year real yield. And if you want to look for some form of strength from gloom, West Texas Intermediate 72.92 launches off $69, maybe a little bit of a tea leaf there. Gold 19.76 the ounce. Currency marks. Thanks, Jeremy Stretch with CIBC for helping out. Currency markets, I'm going to call it one big churn. Euro 108.22. Are you going to brief me now? Is this auction-free brief?
This is auction-free brief. There are auctions, but there are other things that are going on today that are more important, including some of the data that we get. House price data coming out at 9 a.m. from FHFA, as well as Case-Shiller, the 20-city data for January. Do we see ongoing stability after a pretty steady decline in year-over-year prices? And this really is going to be one of the big questions. If you get stabilization in mortgage rates, does that offer some support to one of the most interest rate sensitive areas, right? And this has been sort of underpinning people's belief, okay, well, if the Fed backs away, then does the problem just surge back? 10 a.m. we get also data on consumer confidence, but the more important thing is going to be these hearings in Washington, D.C. Michael Barr of the Federal Reserve, the Vice Chair for Supervision, Martin Grunberg, FDIC Chair, and Nell Yang, U.S. Treasury Undersecretary for Domestic Finance. The system is resilient. Everything's under control. That's what they're going to say. And then the questions begin. Who's next? What did you do? Why did you do it? What precedent does this set?
The look back.
And then what we heard from Greg Valliere, why did the Fed miss blaring red flags? Is this something that undermines the faith in their ability to oversee it? And today we do get earnings. We just got Walgreens earnings that came out better than expected in terms of second quarter sales and adjusted EPS. Yes, but pretty much in line with the year estimate. And so you are seeing just a small pop in those shares, but up 1.7%. We also get Micron, Lululemon, Dave & Buster's, a bunch of other shares coming out after the bell. So this is what we're watching today. I am trying to understand the consumer confidence as reflected in the earnings.
It's bizarre, and it speaks to the confusion of the moment. One of our most popular guests, because of her clear explanations, I should say, of the derivatives market, is Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets. There are cross moments, Amy, and the pros talk about skew as being really important. You state there's a new skew. First principles, what is skew?
Good morning, guys. So look, skew is just your demand for hedging, your demand for downside protection. And what happened, what was missing in 2022 was skew essentially disappeared from the options market. Nobody wanted to hedge. Nobody was worried about downside. And mind you, that's with the S&P drawing down 20% last year. And we kind of came into this year with that same momentum. Everyone was focused much more on up crash. The biggest change that's happened since Silicon Valley Bank in the options market is skew has reappeared because tails have reappeared. The downside tail is still there.
Where's the opportunity there? I mean, for mere mortals that aren't familiar with the derivative mathematics of Amy Wu Silverman, how do you play this new moment, this new type of tail?
Look, the really simple way is that you can own protection through puts or put spreads. You know, people talk about the pickup in skew as making options more expensive. That's true. That's true in equity volatility. But when we look at it cross asset compared to rates volatility, we're nowhere near the momentum we've seen in rates volatility. You know, and folks ask me, is the VIX dead? Why is the VIX kind of so resilient? And I would say the VIX is kind of going through a midlife crisis right now, because if you look kind of intraday, if you look at zero data options expiry, if you look at these shorter tenors, they are flagging a lot more risk than what the VIX is computing. I think, unfortunately, the instrument isn't matching kind of the flavor of the day of how options are trading right now.
So let's talk about what the sentiment is if you see a lot of people hedging against a downturn, but not selling their holdings. They rent the sort of downside protection. What does that mean to you in terms of the conviction underpinning people's concern about the future?
You know, Lisa, I think the biggest difference, and it's a little bit of a nuance, is the way the market is trading. So last year, we did have a drawdown, but it was very orderly. It was kind of this path that steadily marched down. And this year has all been about the whipsaw. So, you know, look how quickly consensus changed its mind, both in the bond market as well as in equities. And I think what that gives you, and this isn't a technical term, but it gives you gappiness. It gives you gappiness to the market. And one thing options love more than anything else is gappiness, because that increases your realized volatility. And that's what you need to pay to play in options. It can't just be that the market marches up or marches down. It has to have those swings. And right now we're getting those swings, and that's what makes options quite profitable.
Amy Wu Silverman, thank you so much with RBC Capital Markets there on the mathematics of a resilient equity market. Lisa, we're bonds, but the heart of the matter is you know, the basic world here of the equity market is, wait a minute, 3% GDP, and there's inflation on top of that. So you do the math, 3% plus, let's say, 5% is what? 6, 7, 8% nominal GDP. That folds over into revenues where, like, the airplanes are packed, et cetera. Do the math. What's it mean for the stock market? And I guess it means resiliency, at least.
Well, Jay Pulaski would agree with you. And we heard that yesterday of TPW Advisors. He thinks that that's exactly the case for stocks, that even if you have inflation that stays above that 2% level from the Fed's target, you do get resilient earnings. That said, in that scenario, bonds are wrong. Long-term bonds are wrong, because what you're going to get is longer-term inflation, and you're going to have a very different kind of Fed rate regime. That, to me, is the tension right now. Either bonds are wrong or the stock bulls are wrong.
Well, my CFA 101 is bonds are never wrong. Bonds are always early, ahead of the stock market, and there's a lot of information there that can be good. But the heart of the matter, to me, on analyzing bonds and equities right now, are not the 1 or 2 inflation narratives, but in this original post-pandemic time, 4 or 5 inflation narratives, and I have no idea how they redound back to those 2 markets.
Neither do bond markets. And you say, you know, bond markets get it right. There is nothing to get right. Nobody knows what's going to happen. And bonds have a theory. Wei Li of BlackRock, who's brilliant, comes on the show. She just put out a note saying bonds are wrong. The Fed's not going to cut rates. You're going to have to basically feature, what we're going to see in terms of a higher inflation regime for a longer period of time. And this, to me, it's unclear whether you actually get this. Whaley's saying we don't see rate cuts this year. That's the old playbook when central banks would rush to rescue the economy as recession hit. We see a new, more nuanced phase of curbing inflation ahead, less fighting, but still no rate cuts. That is something that this market hasn't wrapped its head around yet.
I mean, this is the first time I'm looking at this. You can do this, folks, under ECO Go. It's something I live on every day. It actually makes me get through the show. ECO Go, April 12th, is a CPI report that we get before May 3rd.
Well, and just how about this week? We get core PCE, that real key indicator, a PCE deflator, as well as personal spending. What do we see in terms of people's willingness to go out there and keep delivering their cash into the hands of airplanes and hotels and all the other discretionary, Disney World or whatever people vacation in? To me, this is really one of the big kind of question marks overhanging the market.
Interesting. Jobless claims are May 4th, so the Fed meets before the jobs report of May. That's interesting. They have one less data point there to work on.
Yeah, although people will say, does the data matter? Or does it really just all about bank stocks? I think at that point it might matter.
Well, no, yes, that's an important question, and you'd like to think this will be solved by then. It better be solved by then. Again, I go to deposit flows, and again, money market funds with those good rates that are out there. Futures at -4, Dow futures at -7. Look at the yield dynamics, 4.03% in the 2-year. The 2-year running away from the Bramo call. Stay with us on radio and television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. In Nashville, Tennessee, police have identified the person who shot and killed 3 children and 3 adults at a Christian elementary school. Audrey Hale was described as a 28-year-old white Nashville resident who identified as transgender. She is believed to be a former student at the school. Hale was killed in a shootout with police. U.S. regulators are now investigating managers' conduct in the Silicon Valley Bank and Signature Bank failures. The Fed's vice chairman for supervision, Michael Barr, called Silicon Valley Bank's collapse a textbook case of mismanagement. Barr and FDIC chairman Martin Juniberg testified before a Senate committee hearing today. And a U.S. aircraft carrier group has arrived in South Korea, just as North Korea's leader made new threats. Kim Jong-un said Pyongyang is ready to use nuclear weapons anytime and anywhere. North Korea raised tensions to new levels. The last time a U.S. carrier group was in South Korea was about 6 months ago, and that included firing its first missile over Japan in 5 years. In France, unions are holding another nationwide day of strikes to protest President Emmanuel Macron's unpopular pension reforms. Union leaders are calling on Macron to negotiate. Last Thursday, protests ended in chaos, with some hardcore demonstrators fighting with riot police. And a big structural change at Alibaba. The Chinese e-commerce giant is splitting its business into 6 main units, each of which will explore IPOs or fundraising when the time's right. The units will encompass e-commerce, media, and the cloud. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
To keep rain World Cup. This is a 3 as the economic picture down.
The UK is getting ready to make
our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The debt and deficit has been a problem for a very long time. It is something that we've got to reckon with, but it's not going to be by flirting with allowing America to default on its debt. That's exactly what China wants. That's exactly what our competitors want to see. They want to see our system not work. We need to have ruthless conversations and come up with results about some of our permanent costs and some of the other costs.
Haley Stevens, she's really an interesting person. I had the clearest memory at Renaissance Capital, the Renaissance Tower rather, in Detroit, with Steve Ratner, the car czar, wandering by me with his chief of staff, and she was on the Detroit Red Wings. She put her elbow out, and she could get out of our way, and she was tough as Steve Ratner's chief of staff.
She shoved you down?
Shoved me right down. I mean, there we were doing it.
Do you want to talk about it?
At the time, we had a really good interview, as I recall, with Mr. Ratner, but she was tough as nails. I mean, it was like, 2 minutes elbow. She almost got a 5-minute major.
You still bear the scars, clearly. So,
I do. I do right here.
We could talk about that.
Haley Stevenson of Michigan there, spirited here on the moment that we're in. Speaking of the moment, with Balance of Power, and that's where that image was from yesterday, Emery Horton and Joe Matthew on Balance of Power. They were looking for themes in a boring February. That changed, and as she joins us now, Emery Horton, our Bloomberg Washington correspondent. Emery, just one little story in the Washington Post today. It's completely tangential to what we do. This is the wife of the Supreme Court Justice, Mr. Thomas. Ginny Thomas received $600,000, whatever. The answer is money corrupts. Can you state in your reporting yet that money corruption led to the banking tumult that we're in right now?
Listen, I think I'll leave that to Michael Barr and Martin Grunberg, as they are going to be addressing lawmakers today. I think the questions really that these lawmakers want to find out, and what you hear from them, is that everyone wants an autopsy before they either look at raising an FDIC cap, before they look at more regulation. They want to know, was this a management error? Was this a regulatory error with the supervisors? And they really wanted to get into the fact on what exactly happened here. And also, is there more risk in the system right now?
Yes.
So that's going to be a lot of questions that are going to be facing the regulators today. But also these hearings, which TikTok was a great example of last week, they also just become statements that lawmakers want to make, especially going into a 2024 election season.
What's so important here, and again, I mentioned this, I think, I'm sorry, folks, for repeating myself 3 times, I believe, in the last couple days, and that's the Swiss fury, the people of Switzerland's fury over UBS Credit Suisse. What's the constituent fury that's wrapped around these hearings today?
Well, when you talk to a lot of lawmakers, what they say that they're hearing back home from people who bank with smaller, mid-sized banks, they are concerned, and they call them. This is what Senator Roger Marshall said to us last week. He says, from Kansas, he says that he's getting all these calls from constituents asking if they should be getting out their deposits from some of these smaller banks and putting them into the likes of a Bank of America and JP Morgan. And a lot of these Republicans don't think the federal government was clear enough. Now, some of that, they say, is a political instigations against, say, the Treasury Secretary Janet Yellen. But these are the concerns that they're facing with their constituents, just everyday people and also businesses. Businesses, a lot of them will go over the FDIC cap of $250,000 because, say, they have to make payroll, et cetera.
Right.
Those are where the concerns are for some of these lawmakers.
This is not a correction to the star of Balance of Power, but I want to emphasize that businesses, Lisa, are everyday people. there's this delusion that small business somehow is not everyday people. And I aggressively disagree with that point. This is always featured by Joe Matthew on Balance of Power.
And not only that, but some of these small businesses have to make payroll. In fact, all of them do, and they account for their payroll through some of these banks, which has been one of the big angsts out there of how they could meet payroll if they were concerned about the integrity of those shares of their deposits. I am curious, Anne-Marie, about the size of banks and how you are seeing consolidation. If you look at, for example, First Citizens, which did acquire the Silicon Valley Bank assets, their assets have risen to more than $200 billion from $42 billion just 3 years ago through a series of acquisitions. Is there a greater willingness on the part of representatives to allow banks to get bigger after years of saying big is bad?
Well, this point you're bringing up and this expansion of these banks, like SVB, which we saw expand, what Democrats are going to point to from the rollback of Dodd-Frank in 2018 to being one of the top 20 biggest banks before they fell, before FDIC had to take them into their control. This is going to be a main point for the Democrats, besides the fact that they're going to try to hammer the regulators about where were you, where's there enough supervision. They are going to want to point to the fact and draw a line between the failure of these banks and the rollback of some of that regulation for these smaller mid-sized banks in 2018. And they're going to bring up examples like you just did, Lisa.
Do you think that policymakers at the FDIC and the Federal Reserve are going to come out and say, actually, that's the reason for this? Are they going to actually put the blame on the loosening in regulations around smaller banks, or do you think they're going to stay apolitical and just try to say as little as possible throughout this whole thing?
I think what they're going to do is try to stay as apolitical as possible, but also really talk about the work they did before this crisis. So already from the pre-testimony, we know the Vice Chair of Supervision, Michael Barr, is going to talk about the number of times that he and the Fed has pointed out potential risks at SVB, most notably about their short-term paper when the Fed was hiking interest rates.
Emery, a dumb question, but it's Dumb Question Tuesday. Can the president take a victory lap yet on the bank crisis?
I don't think so. What you've seen the president do is really try to step away from this after he came out before the market opened when he talked about what they did. This was, 2 weeks ago or so? The only other time we've heard from the president was when he was in Canada, and he said that he thinks they've done a good job. He said, when do you not know a Wall Street that's not in consternation? And he said he doesn't see an explosion, but potentially, it's going to be a little bit rocky, but he doesn't think things are going to explode on Wall Street. I think what the president is trying to do is have his Treasury Secretary lead on it, the Fed lead on it, and whatever he can do, take a step back. He's going today to North Carolina. He's in full-on campaign mode. Him and his cabinet and the vice president are going to be going to 20-some-odd states talking about what they deem as their biggest victories of the prior 2 years, and that's Inflation Reduction Act, bipartisan infrastructure, and chips.
Anne-Marie Horton, thank you so much, our Chief Washington Correspondent. I should point out, Anne-Marie Horton and Joe Matthew, it is Balance of Power, Bloomberg Television at 5 p.m. There's already an immediate buzz on the intensity here. Do you know what's great about them, Brammo, is just like us, they're not on speaking terms.
That's fabulous.
It's just great. I mean, they show up, they don't talk all day. They show up at 5 p.m., they do the show. There's no notes, no preparation, no nothing. And, it's very intense, actually.
It sounds like a different kind of intensity. I do think it'll be interesting to hear the fallout from the hearings today, especially as people try to blame the Fed and how this ties into monetary
it's a
policy.
Sell, though. I mean, they got to be testing, how angry should I be? What kind of angst should I have here?
Well, right, correct. And want to blame somebody but not actually have to bail out anyone or be accused of it, right? So if you have the agencies bailing out these banks, essentially, then you don't have to assume responsibility as the politician, right? How much are you going to try to see that game being played out in real time?
1-year Treasury, 4.46%. Let's see, what else do we have here? U.S. dollar deposit rate, 1 month, 5.02%. Ask 5.12%. Is anyone modeling out if those numbers nudge up? I don't think one single person out there saying, persistent inflation or even sustained service sector inflation, deposit rate, 5.1%. Nobody's there.
I can give you one person who is.
Okay.
Andrew Hollenhorst. He has been absolutely persistent at Citigroup, talking about how this market is wrong. The Fed's still going to raise rates, and they're going to get to 5.25% or 5.5%, and that is really pushing against the grain. He's not alone.
I'm doing his fire jersey because he hates when I do this. 3-month LIBOR. That's the money. That's the old style system from 2008, and also it's in Mary Poppins. 5.16%. I did not know that. 3-month LIBOR is 5.16%. It's like the banking scene in Mary Poppins. You've seen Mary Poppins, right?
Come on. Yes, of course. The sort of punching through the hat. Is that what you're talking about?
No, I'm talking about railways to India. We'll be back. Lisa Bramowitz and Tom Keene. Jonathan Farrell rumored here tomorrow. Stay with us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg surveillance on a Tuesday on radio and television. Really, really interesting day here. Yes, off a crisis. There is no crisis, and we're looking at markets that are really, really nuanced. A little lift to the market in the last 5 minutes. We've gone from red to red and green on the screen. These are all fractional moves. Not so in the 2-year note. I mean, take it out. I'm going to get the chart up here right now. Lisa's going to be impressed that I know it's USGG2YR. Thank God Tom Secunda invented the you know, the thing you can do where you can see a list of things to go there. And what I'm looking at here, really, folks, on the Bloomberg terminal is that plunge in yields, the 5% level, down well under 4%. And Lisa, that low that we had on the 2-year was 3.76-ish. And we're up 25 basis points just like that.
It's shocking to see some of these moves. It's been incredibly volatile. And this is really underpinning people's uncertainty about the path forward for everything, for all risk assets.
And you know, you look at it, and you know, I look at the 2-year is the metric here for everybody watching and listening here, but there's got to be other metrics as well. And to me, it's not outside 2-year, 10-year yield, 30-year mortgage, and that. It's the inside, the Ira Jersey space that probably is more informative right now.
Well, there are different aspects of the economy, and I'm watching a number of different stocks, in particular in the retail sector, that I find fascinating, because we're talking about how consumers are going to lose confidence and how everybody's going to stop spending. We aren't seeing it yet. You're not seeing the cracks yet, and that is what Laura Rain was talking about yesterday. PVH, which is the parent company of Calvin Klein and Tommy Hilfiger. Those shares are up almost 12% in pre-market trading after delivering earnings that beat expectations and looked for a pretty strong growth this year. Again, square this with a sense that nobody has any money left and no one's going to spend ever again, right? I mean, this is sort of the reality check that you're seeing in terms of, to your point, adapting and adjusting, making profits and still having sales. Walgreens Boots Alliance, similar story. Those shares higher. It's not as sort of blockbuster as PVH in terms of the beat, but those shares up more than 2% after beating on the second quarter and then meeting expectations for profitability going forward. This is interesting to me.
And this is a workout of, let's be clear, a failed mating. Walgreens and of London Boots, and it just from day one didn't work.
Well, this is the product of a company that can earn a lot on people who want to buy makeup and face cream that costs a lot of money, and so they can really get boosted on that front.
And
at the same time,
you 25 cents for the 3 bags to carry the stuff home.
Do you have any bitterness that you'd like to talk about?
No, you know, I need Walgreens therapy here. Very dangerous store.
We all also are looking and trying to understand the retail theft, which we've heard consistently across a whole host of different retailers, but particularly with the drugstore rings, given that there are specific gangs that are going after drugstores in particular. And Lyft, we're seeing up about 4.6%. And this, to me, is interesting because they did just appoint David Risher as the new CEO. Reaffirmed first quarter guidance. The bigger question here is, how do they compete with Uber? Is this a two-tier, a two-company kind of business, or can they claw back with Uber gaining dominance?
And this is really important, folks, and full disclosure, when the Bentley's in the garage, I'm taking Lyft every morning. I mean, I'll do everything I can not to take Uber, to be blunt about it. But do we need a second competitor in something that's, am I right, Lisa, it's almost a proxy utility? I mean, what's the difference between the way you and I use Uber and Lyft? You ever summed it up at the end of the year?
It's shocking.
It's shocking. I mean, and for folks, for those of you across the country with 3 cars in your garage, you know, Lisa and I are living the Uber Lyft life, and it's shocking what you end up paying on this stuff.
I also use the subway, to be fair, but I do think, to your point, there is this question: is it a utility? Or is this something where you need the competition to bring down those costs?
Do we need the competition?
And you have the competition. We used to be that there was no competition with taxis. Now there is competition. It brought down the prices. They're starting to creep up. And you can feel that as they start to creep up, and people are just eating it.
And
so we'll see.
One comment here, Dan Ives on Wedbush was out on Twitter, of Wedbush, I should say, out on Twitter, was pretty scathing about Let's Go. This guy's first order condition would Lyft is to right the ship.
When we talk about adapting and adjusting, one of the big questions underpinning a lot of the moves that we've seen recently is whether or not you're going to have a change in Fed policy. And you can argue it's not fun to play the parlor game, but the entire market is. Victoria Fernandez of Crossmark, among them, talking about how the tightening of financial conditions from the banking issues of the last few weeks has allowed the Fed to take a more dovish approach to hiking rates, where we anticipated rate hikes at the March, May, and June meetings a month ago. We see only one 25 basis point hike left in the rate hike cycle. This is the theme that we keep hearing, Tom. It's over. We've reached the end of the rate hiking cycle. Now you can reassess what's the damage and even start to get a little bullish on assets that previously were left for dead in the new higher rate regime.
Joining us now, Victoria Fernandez, whose major charm is she's not on the island of Manhattan. She is out there and across the rest of America. Also on with us because I have a final 0, and she's actually, I think she had 1 or 2 of the final 4 picked out, so she's our resident genius for March. Victoria Fernandez, I'm going to cut to the chase. There is a banking crisis, and it plays differently among the financial centers than it does across Texas and the rest of this country. Tell us how the financial crisis, the banking crisis rather, that we're in now, adjusts the strategies of Crossmark Global Investments.
Yeah, well, first of all, I'm going to say, unfortunately, my Cougars are no longer in the Final Four, but that's okay. We'll go from there. When we look at what's going on in the banking sector, we have to say, wait, all of this has tightened financial conditions. That's the key point that we're looking at right here. So when you have tighter financial conditions, which the Fed has been trying to do for such a long period of time and has not been very successful at it, the banking crisis did it pretty quickly. People are saying, depending on what analyst you talk to, it could be anywhere from 25 to 100 basis points of rate hikes that they have seen because of the crisis that's kind of now built in. Here's what we have to watch with that. When you have tighter financial conditions, you guys were talking about the smaller banks that are out there. Let's look at the senior loan officer survey that comes out in a couple of weeks and see what is happening with lending. It's probably coming down. That's going to affect M2 growth. It's going to affect economic activity. That flows through to earnings because pricing power is gone. Margins are going to get hit. And that then flows through to the labor market. This is the progress that the Fed is watching. They want to see this happen. And so I think fits into their story. But Tom, here's the thing, that can change pretty quickly if the data changes.
So how do you change equity allocation? I mean, the charm of Crossmark is you're working with real people, with real money. Everybody, including me, is real scared about some of the banking news that we see. Given some level of new restriction or super restriction, how do you change your equity allocation?
Yeah, well, John's not there today, so I guess we can talk about the Dow a little bit.
Continue.
We've seen the Dow down year to date, but we've seen the NASDAQ and the S&P higher because of the big turnover, people going into those tech stocks. What we're actually doing at Crossmark is trimming some of those tech stocks because they've had this run, and we don't anticipate we're going to continue to see it because we don't think rates are going to continue to fall right here. We think we're going to see them turn around. We continue to look at quality names, names with strong balance sheets, names with good business models. That's what we're focusing on. We have some cyclical. We have a little bit of growth in there too, but some of those value names. It's when we hit the recession, which previously we would have said that was later in the year. Now we're looking more summertime. That's when you're going to start to go a little bit growthier. That's when you're going to start to look at maybe the lower quality names that tend to do better once we hit a sustained recovery.
What are the quote unquote lower quality names in the Dow Jones Industrial Average?
Well, I think you just have to look at some of the names, some of these that have been really hard hit. We're looking at names that do the opposite of what we were just talking about, that typically don't have the strongest balance sheets. Their earnings are not the strongest there. I'm not going to give specific names on those because we're not buying them right now, so compliance would be a little, have an issue with me here.
Yeah, but nobody's watching. Continue.
Yeah, exactly. So you can't do that. I will say names that we have been adding a little bit to. JP Morgan, because of what's happened there and their valuations look strong. Some of the more stable names that we have in there and healthcare names will come out of those and go into some of the other names, looking at the more cyclical growth names once we hit a recession, looking at middle of the year.
Victoria, if the Fed cuts rates, do you get more bullish on risk assets?
It's an interesting question because it depends why we're seeing rates being cut. If we're seeing rates cut because we anticipate a recession, we're going to wait a little bit longer. If we're actually in a recession and we're cutting rates and it's the start of a new sustained bull market, then yes, then I think you can do some risk assets. You don't want to go into those names until we get to the recession. You don't get your bottom in your market before that. So we need to wait and see that. We're not particularly saying 100%. We've already seen the bottom in the market. So we're still being cautious, biding our time a little bit. I'd rather be a little late to the party than get there early and not have anything there.
Just quickly, Victoria, what's the best hedge right now against a potentially higher inflation environment for longer?
Well, look, you're asking a bond girl this question, and so I'm going to tell you, you need to have that diversification in your portfolio by adding some fixed income. And don't just add short-term fixed income because you're setting yourself up for interest or for reinvestment risk. once those bonds mature. Do a barbell strategy, add some fixed income, and then the equity, add some of those names.
Bond girl, with 30 seconds here, United Healthcare with that ginormous bond deal, it takes them out to 11%, 12% debt, which many people in the textbooks would say still underdebted. United Healthcare in the last 10 years is up 25.6% per year. That's their stock. Are we going to see a ton of issuances by the quality names of the Dow Jones Industrial Average?
I wouldn't be surprised if we did, Tom, especially if people anticipate that rates are going to go a little bit higher. If they believe the central banks that there's more work to do, then we could see some issuance come in and lock in some of the lower rates that they have right now.
Victoria, thank you so much. Victoria Fernandez there, Crossmark Global Investments. I'm sorry, it's a theme of mine here. When I was, I was with Stuart having a rum punch. I'm sitting there with 6 guys from Goldman and 3 from Morgan Stanley and somebody from Crossmark, and we're all sitting there hanging out, and there's the United Healthcare bond offer, and I just said, this is the beginning. Every CFO's got to look at that and just go, we got to get more bonds into our capitalization structure.
The problem is if you get a lot of volatility in benchmark rates, it becomes difficult. And it becomes difficult to figure out how to time the market, and that's what we've seen with the new issuance market pretty frozen over the past couple of weeks.
Is it unfreezing now?
Slowly, but it really has been slow. People want to have more certainty at a time where there's very little of it.
We will have to see. What we've seen is improvement in the tape in the last hour and a half. Red and green on the screen right now. Futures flat. Dow futures for Victoria Fernandez. Dow Jones Industrial Average futures up 26. Lisa Bramowitz and Tom Keene. John Farrell rumored back tomorrow. We'll see on that. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Police in Nashville, Tennessee say the shooter who killed 3 children and 3 adults at a Christian elementary school may have been an ex-student. Audrey Hale was described as a 28-year-old white Nashville resident who identified as transgender. Hale was shot dead by police. In Mexico, at least 39 migrants have died in a fire at an immigration center across from El Paso, Texas. Another 29 were injured. The city, Ciudad Juarez, is a major crossing point for those wanting to enter the U.S. Did the Federal Reserve do enough to oversee Silicon Valley Bank, the lender that collapsed earlier this month? Well, that's what a group of Republican and Democratic senators want to know. They've sent a letter to Fed Chair Jerome Powell asking if the central bank exercise its full authority to supervise Silicon Valley Bank and other mid-sized banks. Google has asked a federal judge to dismiss the U.S. government case over dominance in the digital advertising market. Google argued in Monday's filing that the case ignores the company's biggest rivals in online advertising. The lawsuit calls for breaking up Google's ad technology business, one of its main sources of revenue. And Adidas and Beyoncé have reportedly agreed to end their fashion partnership. According to the Wall Street Journal, that comes after years of weak sales for the performer's Ivy Park line of clothing. The Journal says sales fell 50% in 2022. Meanwhile, Adidas was paying Beyoncé about $20 million a year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I don't think we're quite out of the woods yet. Our position has always been that when the Fed tightens aggressively, it exposes the excess leverage, the excess risk in the system, and that is going to cause things to break, and we've certainly had an element of that.
Lisa Hornby-Schroeder, I thought she was outstanding yesterday on where we are in bonds. Then it was a 3.9x on bonds, now 4.03. I thought Lisa Hornby was on fire yesterday, Lisa Abramowitz.
A lot of people are taking a look at what the market is pricing and saying, actually, bonds usually are smarter than everything else, but right now, not getting much of a signal and not probably right.
We welcome you. Bloomberg Surveillance here in the 7 o'clock hour on radio, on television across this nation. We'll have much more on news through the morning and also some interesting guests in the 8 o'clock hour to discuss Views Forward. And the Views Forward are these hearings today, which I'm sorry, Lisa, I was wrong. I thought they were like a non-event, and all of a sudden, I think they've got some real merit. They could be some real, not yelling and screaming, that's too theatric, but there could be some real tension.
There's the sort of punditry of it, but more important to understand what policy could emerge from this, I think is going to be really salient.
And maybe what will be interesting is the bipartisan effort in Washington will not be mentioned, and that is, of course, on China. This morning, Bloomberg reporting that Alibaba shares, well, they're rising in the pre-market. A Chinese e-commerce giant announcing an historic overhaul, splitting into six separate units. And what is so important about this is a meeting I attended what was a lifetime ago, 8 years, summer of 2015, at a packed Waldorf Astoria as Jack Ma announced Alibaba. You would have thought it was a second coming of whatever there. It was I've never experienced, Lisa, anything like what I witnessed of Jack Ma's coronation at the Waldorf Astoria on the new Alibaba.
He's a rock star. He used to be a rock star. He used to come out. It was Tim Cook on steroids. It was sort of the Elon Musk coming out and just cheering crowds. These are my people. How much things have changed in a very different China with a very different backdrop in terms of supporting businesses.
To give us a perspective now, our definitive expert on China, Stephen Engel, in his very late evening in Hong Kong. Stephen Engel, I want to go beyond the headlines here, just to your perspective on the government, on Mr. Xi, and on Jack Ma. Is Jack Ma still part of a new 6-unit Alibaba?
Yes and no. He is the face, obviously. He is the founder, co-founder of Alibaba. And I love this story that you just talked about meeting Jack Ma. I've met him many times over my 20 years at Bloomberg and 32 years now in Asia Pacific. And he always talked kind of, not nonchalantly, but a bit of a chest puffed out about regulation and that how he had to stay ahead of the regulators. Well, obviously the regulators caught up with him in October or thereabouts of 2020, scuppering that big, multi-universe IPO for Ant Financial. And since then, the company has been absolutely obliterated, going from, I'm not talking about Ant. Ant's been sidelined, absolutely. But Alibaba's gone from an 800 billion valuated company down to about 220 billion. So now they're going to not break up, but they're going to kind of be reshuffled. Is this at government order? We don't know. Is it going to unlock more value than the pre-breakup, if you will, or pre-Ant breakup? We don't know yet. A lot of questions to be answered.
There is, though, one clear underlining feature here, which is government intervention in businesses that used to be the darlings of the nation. This person who used to be Steve Jobs, but even much more so in terms of the reception that he would get on stage and in these sort of rock star events that he would hold. Stephen, what does this say in terms of the climate right now and how quickly it is changing in modern China?
Well, the government's trying to say all the right things. Keep in mind, they're having the China Development Forum. In fact, in Beijing right now at the Diaoyutai State Guest House, just wrapped up today. Tim Cook is there, Ray Dalio, and a few others. But a number of big name U.S. CEOs kind of stayed away, not necessarily wanting the blowback in the United States because of the relationship troubles between China and the United States. But then they're going to have their World Economic Forum called the Boao Forum that started today as well down in Hainan Island. They're trying to make the sales pitch back to skeptical global investors after 3 punishing years of COVID-0, as well these simultaneous regulatory crackdowns on the platform economy, on the private sector, on property, on online gaming, on so many sectors of the economy all at once. They're talking up the private sector. The government wants to support the private sector. But again, we've kind of rolled our eyes a little bit because we get tired of the narrative for 3 straight years of saying they want to do this and then acting differently. I'm gonna throw a little bit of caution on this. The market likes this right now. They think this is an opportunity to reinvigorate and get that entrepreneurial spirit back into a behemoth, which was a behemoth, Alibaba, but it's been dwindled down by regulation as well as largesse.
Stephen, what is the public reception to the intervention of the Communist Party of China in some of these previously much heralded companies that represented the mainland?
I think there's a lot of frustration. That's anecdotal. I mean, I do talk to my sources in mainland China. There is a bit of frustration. Few people will go on record to say there's frustration, but there's been a power grab, if you will, at the top of echelon of leadership there, with Xi Jinping almost becoming absolute ruler with his loyalists as his deputies. So there's some speculation or some skepticism, if you will, that the good old days, perhaps for the private sector, are past them. But again, we just don't know, Tom.
Stephen, what's so important here, and to use your years and years of expertise, behind those red doors in Beijing, they're obviously recalibrating after the political moment of November, after the coronation, if you will, of moving Mr. Xi forward. And then the reality is we're hearing reports from Bloomberg News and others that the Belt and Road Initiative, to be polite, is struggling. How successful right now is their business, is their finance, is the Chinese capitalistic experience?
It's struggling, obviously, coming out of 3 years of COVID-0 that really decimated confidence. It decimated investment coming into China. It perhaps also harmed, in a more tangible way, the confidence that others have in China. So the Belt and Road Initiative has turned into what some would say is debt diplomacy in some countries that are having some debt issues, obviously. So the jury's still out on the Belt and Road, for sure.
Stephen, one final question, if I may, with great respect for your years of service in Hong Kong. Is Hong Kong, the new Hong Kong, is it open for business?
It seems like it's open for business, and they're sure doing everything that they can. And we'll have to see as well whether the IPO market is going to rekindle confidence in Hong Kong as well. And that's one interesting thing. I'll come full circle on the Alibaba story. Those 6 individual units, Daniel Zhang, the CEO, says each one of those 6 individual units will be able to do their own fundraising. And if that means IPO, that means IPO. It's going to be up to the heads of those individual divisions. That could, because no restructuring like this would come without the blessing of the central government in Beijing. So this could mean that IPOs could be coming back to Hong Kong.
Our Stephen Engel from Hong Kong today. Lisa, what's so important to me here, and I go back to, I was in Washington, and it was when Mr. Hu came to Washington. And I had back-to-back Orville Schell and the giant Jonathan Spence of Yale University. And you look at the modern search for China, the classic Jonathan Spence textbook. And all of this just seems to be a continuum of that. It's just another 100 pages of an 800-page book. It just seems to migrate forward with a new always of this ginormous country. That we talk about numbers. There's no numbers here. It's about the people of China.
This used to be a nation that prioritized growth above all else. This used to be a nation that really wanted to incorporate itself as the factory of the world into the sort of global ecosystem and rise to be a world power. And now the focus has shifted.
Well,
we're talking about the potential inward look about bringing up the middle class and coming up with some policies that run counter to some of that growth profile and to some of that sort of preeminence in terms of corporate excellence.
And one example here, which you see on the terminal here with Enda Curran and Stephen Engel, Yvonne Mann, and others, Bloomberg News reporting this morning of China anti-graft agency to inspect the major state-owned firms, part of the continuing experiment of China. Red and green on the screen right now. Please stay with us. This is Bloomberg Surveillance.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. World number one Carlos Alcaraz continues his quest for the Sunshine Double Tuesday when he faces Tommy Paul for a spot in the Elite Eight. The American won the only previous meeting these two had in Canada last summer and expect more fireworks at the Hard Rock Stadium. And don't forget, you can watch all the action exclusively live on Tennis Channel. I'm Erin Coscarelli.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
We're investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Fed is aggressively raising rates. At some point, they do usually push the economy into a period of deep slowness, if not contraction.
You should be more positive equities now than a month ago.
The bond market is somewhat, dismissing the Fed's dot plot.
The market's still pricing in 3 rate cuts from the Fed by year end. I just don't think that's happening.
We already had a slowdown coming because of the lagged effects of Fed hikes, and now we're adding onto that a banking crisis, and that, of course, increases the risks that the slowdown is going to be faster.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Can we write the chapter on a banking crisis before it's over? This, to me, is one of the big questions as we wait for these hearings. Welcome back. This is Bloomberg Surveillance. Good morning. I'm Lisa Abramowitz. Tom Keene, Jonathan Farrow off. He will be back tomorrow, and we're looking
sure
at
of that? I'm not sure.
Okay, fake news maybe, but I'm curious about what we could see potentially when it comes to the hearings, the banking crisis, and the feel in markets. Crisis averted.
And what we do at Bloomberg is we look at the tape, and my tape is a yield back above 4%. What do I mean yield? The yield is the 10-year yield. No, the 2-year yield. This is where all the emotion is seen in that bond volatility. And the fact is I correlate that with West Texas Intermediate lifting above $69. There's a certain feel-goodishness out there as we go into these hearings this morning.
And it really is making my angst go nuts. And I have to be honest, yes, this is my Debbie Downer moment, that right now I'm looking at a situation.
So late in the morning.
Where there are two really conflicting ideas. People saying that the crisis is averted, it's not going to cause massive stress, but the Fed's still going to cut rates at a time when you have inflation that's running hot and economic data that's strong. So this to me is a tension. What are people seeing that has to play out that isn't yet?
And what's really important here is Farrow's not here to defend you, because I just think the parlor game is way overplayed as a measurement to, make money or lose money, the opportunity to guess what the Fed is doing. What I'm going to guess is buoyant GDP. JP Morgan Publishing, maybe this is the top of the market in Q1 here. But once again, no recession. Buoyant GDP, a better America, an equity market that won't go down, even though the equity market is exactly 2 stocks, Microsoft and Apple. And the basic idea here is we're still data dependent to the May 3rd meeting. And is there still any idea that they could raise rates at May 3rd?
To be clear, love John, can't wait till he comes back. I don't need him to defend me, because in this case, what people are looking at very much is what you're saying. And they're saying, look around, sky is sunny. Why are you saying the sky is going to fall? And other people are saying the banking situation is the first crack, or one of the cracks, we've seen a bunch of them, that highlight stresses that are coming down the pipe that are going to hit in a more significant way.
Yeah, the important thing to me, and I honestly, I didn't look at the BTMM screen, definitive money market screen of Bloomberg, really an advent of the terminal with yield, with a yield measurement screen from 25 years ago. It's the go-to, and the answer is 3-month LIBOR is well above 5%, and that tells me, deposits are going to flow.
Well, and this is what we're seeing today. Certainly, you pointed the 2-year yield. That is a place to watch, where you do see this sort of whipsaw action, just up marginally, 4%, pretty much across the board. 10-year yields also up just marginally, 3.5%, 3.54%. But really, the tone right now kind of jittery. S&P futures now basically flat. Not getting a sense. Can we say the all clear? Can we rally? Can we get a sense that perhaps the Fed will cut rates and we'll still see growth continue? The soft landing, the no landing that a lot of people are saying seems unrealistic.
Well, there we are, and a good morning to you on radio and television. We mentioned yesterday, Adam Posen was with us, PhD from Harvard. He was lights out, I thought. And one of the reasons we had Dr. Posen on is Dr. Furman of Harvard, teacher of Ec 10, which is the definitive economics course there at Harvard. Mankey used to throw chalk at people on it. And the answer is that was on globalization. That was on all the dynamics that are out there. And we've got a guy to start us off strong in this hour. Lisa, why don't you bring in not Kenneth Rogoff, but Bradley Rogoff, who, I can understand why people got the two of them confused in economics, but why don't you bring in Brad Rogoff on this bond mess he and Barclays wrought?
I had Feldstein as my Ec 10 professor at Harvard, actually, so I'm dating back before
But
Mankiw.
I wonder what Marty Feldstein would say of this crisis. He would say we have to clear the market, clear out the losers, wouldn't he?
I think that's probably about right.
That's probably about right. We're not doing that right now, from what I can tell.
Well, but Brad, how do you make sense right now, as the head of FIC research over at Barclays? How do you understand whether the market is just simply wrong to price in both rate hikes and some sort of disinflation that continues?
Yeah, I think we don't agree with that. I'll start with that. I think we expect, yes, could there be rate hikes coming when you get to 2020, rate cuts coming in 2024? Sure, right? But we think there's going to be one more hike this summer. And it is hard to marry, I think you guys were just alluding to it, where equities are, which don't seem to go down, and when you look at what the market's pricing in terms of eventual cuts later this year. Now, Lisa, you were kind of alluding to some of the stuff around banks, and look, this is a banking crisis, but the reason, I think we're calling it that, I guess, at this point, but the reason we got there is very different than a lot of other banking crises. It wasn't because of bad assets, right? It was because of duration, really, more than anything. I do think there's a little bit of a distinction between that, and I guess if you had to choose your crises, I'd probably rather have this one.
But there's also a distinction between the idea of bank failures and the idea of credit materially constrained and more suddenly than it has been in the past. How do you draw that distinction in terms of how to price that into a market that's looking for either 2008 or all clear?
See that is the difference, right? Is maybe right now we can say we're clear of the crisis that we went through, especially the last couple of weeks, but it has consequences still. And those consequences don't have to be 2008, I think, to your point. Those consequences can be slower growth. And whether we get to, you were alluding to some forecasts of a modest recession in the back half of this year or early next year, some people have that in, or just really low, near zero growth, which is what we're kind of closer to. Those have a big impact and also probably aren't that consistent with where equities are today, right?
I had a guy just email in. He's watching the show on JetBlue Airlines. I think it's on DirecTV. Thank you for DirecTV and JetBlue for putting us on across the nation. But he's got a really important question. And that is, okay, we had low-rate free lunch for decades, and now we're back here. Is this rate regime behavior forward, like what you and I studied, or is it something new, this new higher rate regime?
Well, I think that, if we don't have to go back that far to have a rate regime like this, right? We can go back 15 years, a little more than 15 years ago and have that. The difference, I think, is that prior to that, we didn't have the really low rate regime. So I don't think it's just the fact that we have this, some might argue more normal as opposed to high rate regime right now. I think what it is you had that period of such low rates, so then it leads to so many assets in fixed income specifically pricing at a substantial discount, and that leads to the disconnect that led to the problems that we saw in banks. So I do think it's the low rate regime that's causing the problem as opposed to the current rate regime.
The whole financial system, and I'm going to go back to Chris Whalen's glorious one volume on the American financial system and crisis as well. So I got a guy on JetBlue or whatever airline they're on watching this show, and what it signals here, Bradley, is the fear that's out there. Should we fear this new rate regime?
As I said, I don't know that we need to fear the current rate regime, also because by having hiked the way the Fed has, they do have some room now to actually, through non-extraordinary policy, have an impact if we get to a place where inflation's come down a bit, let's say, later this year, early next year, and growth has come down. So I think in that sense, you'd almost have, more fear if this was happening and rates were at zero today. Right? I think that could be quite problematic.
I strongly agree with Lisa, to me, this is the heart of the matter. And there's so many younger people who didn't study Martin Feldstein a million years ago. Where can we celebrate that this is maybe normal with proper incentives of capital versus Mr. Rogoff's comment there on zero?
Well, I would argue that it's really too soon to tell. And I think that to your point, Brad, and this to me is really the key point. It's one thing to have a normal rate of interest. It's another thing to do it after years and years of 0% rates that inflated assets and caused leverage to build up at a rate that might be infeasible for companies based on their business model. So how do you discern what seems like something that gives you income versus something that will crimp companies, cause higher defaults, and create someone to charge a much higher risk premium?
It's very interesting because what did we all expect? And I'm sure you had a lot of people on this show say it. Well, how are these Fed hikes going to impact the economy? Where are we going to see the problems? Well, the answer was going to be, maybe it's going to be the consumer, for example, right? It's going to be higher levered assets in credit, right? The world that I spend a lot of my time in. It turns out it was the safest assets that led to the first part of it, right? And I think that's what you're getting to, Lisa. there will eventually be some impact, right, on those riskier assets, things, lower rated, high yield bonds, and all of those things. But just like 2020 is helpful in the sense of, and I know it's hard to say this looking backwards, but there were companies that were higher levered, that were problematic, they defaulted then, and not as much excess built in the system. So I think just like that, having this little bit of a preview, I do think that even though we will see defaults come up and all of that stuff, I don't think it'll be as extreme.
So this, to me, is one of the big questions, especially with the banking issues that we've seen. Is this perhaps froth that we've already seen pushed out of the system, or is there another shoe to drop? Where would you look for that other shoe to drop?
Yeah, and I think, it's a question of just, from how far up you're dropping that shoe, right? Like, so there will be eventual impact in terms of, okay, if banks are lending less, that has to have an impact on corporate America. I do think we come into this fundamentally in a pretty good spot, right? And so we don't expect the normal, recession default rates are 10, 12% that you've seen, right? We expect it probably be more like half that. However, there's other areas, right? If you think about the increase in rates, commercial real estate is the one that's coming up quite frequently right now. And
we should extend the interview.
Yeah, that's why I came into the studio. And that's one where obviously with cap rates have to move when rates move. And so I think there are a lot of other areas, and that has an impact too, because people hold that on balance sheet.
We've got 30 seconds left, which is a perfect time to dive into this. Commercial real estate, challenged, right?
Yeah, I think it is. We're pretty focused on office as being the area we're most concerned about. And, we think the peak to trough there could be up to 30%.
Brad Rogoff, thank you so much. Bradley Rogoff is with Barclays here. Maybe that's a theme for the summer as well. Lots of people watching commercial real estate across this nation. Red and green on the screen. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Nashville, Tennessee, police have identified the person who shot and killed 3 children and 3 adults at a Christian elementary school. Audrey Hale was described as a 28-year-old white Nashville resident who identified as transgender. She is believed to be a former student at the school. Hale was killed in a shootout with police. In Mexico, at least 39 migrants have died in a fire at an immigration center across from El Paso, Texas. Another 29 were injured. The city, Ciudad Juarez, is a major crossing point for those wanting to enter the U.S. U.S. regulators are now investigating managers' conduct in the Silicon Valley Bank and Signature Bank failures. The Fed's vice chairman for supervision, Michael Barr, called Silicon Valley Bank's collapse a textbook case of mismanagement. Barr and FDIC chairman Martin Grunberg testify before a Senate committee hearing today. Some of the biggest banks in France have been raided by the country's financial prosecutor. It's part of an investigation into tax fraud and money laundering related to dividend payments. Among the banks being searched, Societe Generale, BNP Paribas, and HSBC. They could face fines totaling more than $1.1 billion. And a big structural change at Alibaba. The Chinese e-commerce giant is splitting its business into 6 main units, each of which will explore IPOs or fundraising when the time's right. The units will encompass e-commerce, media, and the cloud. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market's still pricing 3 rate cuts from the Fed by year end. I just don't think that's happening. Markets are obviously trading on fear and panic. It's hard for me to see this banking crisis lasting, another month and a half. I think at that point, we may get the awkward to actually continue hiking.
Winthin there with Brown Brothers Harriman. He was outstanding yesterday on a more global, more holistic view of higher interest rates. And the overwhelming reality is not so much higher interest rates, but the speed of movement. We've seen that, Lisa, certainly in the last 2 days, moving out to 4.02% in the 2-year yield. I looked at the chart carefully, and it is a yield structure of lower highs. We have by no means technically broken out into a yield recovery in a 2-year yield. I think I can say that with some certitude.
North of 5% yield seems far away at a time when people are playing around a 4% range. And just imagine a matter of weeks while getting this. We haven't talked a lot about jobs and the labor market and how hot the labor market.
Yes.
And I think that that's important, especially as we talk about some of the push in the U.S. to try to bring a lot of business home, in particular in the semiconductor industry. And that's why I really think I'm curious to hear from people who are trying to hire and expand at a time when we have a real tightness in the labor market. Greg Lowe has been going to be meeting with President Biden, who's going to be visiting his Wolfspeed semiconductor manufacturer in Durham, North Carolina. He's president and CEO, joining us now. Greg, I want to start there. We talk about some of the initiatives to try to bring semiconductor and tech manufacturing to the U.S. How difficult is it to hire people?
Well, first off, thanks for having me today. We make semiconductor chips using a technology called silicon carbide, and there's a pretty significant transition right now from silicon to silicon carbide in the semiconductor industry. And so for us, actually hiring has been a real positive. We're kind of the future of the technology, so scientists and engineers are very excited to come on board. I would say we're also doing a really, really good job with our talent pool. We've got a very strong relationship with NCA&T University. We bring in interns every year. We show them, what the technology is like and so forth. And, it's been real positive. Now, from a labor perspective, the folks operating the machines in our factories, that's obviously a little bit more difficult. But we try to create an environment that inspires people, that incentivizes people, and makes them feel like they're making a big impact. And I think that's how we're dealing with it.
How much are you counting on immigration or some sense that we will get sort of some increase in the labor force to ameliorate that at a time when we do hear about such a push to bring business home, to bring manufacturing back to the U.S.?
Well, Lisa, what's really important here is developing a pool and a pipeline of potential employees for the future. And you do that by motivating young students to pursue science, technology, engineering, and math in universities. We do that through scholarship programs. We do that through paid internship programs. These sorts of things incentivize students to study the technology areas that are very, very important to us. And if you can increase that pool, you can increase your workforce. I think the other thing that's really important is that women and minorities are underrepresented in science and technology. And we have a very specific push at the high school and at the college level to encourage more women and minorities to join and study engineering and math. In fact, our intern program, 50% of our interns are female, and greater than 50% of our interns are diverse. So, having that as a extra sort of effort, increases the pool of potential employees for us.
Greg, what's so important here, and you know the mathematics of this, there's a simplistic vector of the value of a manufacturing operation and the government subsidies in general given out, and there's a time function of when those two lines cross. At what point is break even on the project the president will visit? Is it out 1 year? No. Is it out 5 years? Maybe. Or is it out much further?
Well, I'll tell you, the demand for our technology is basically exploding right now. We've shown our investors that our power device business is going to have a compounded annual growth rate through 2027 of 60%. And so the payback's actually shorter than you think, Tom, because especially when you get the incentives that we're expecting for this program, the payback is inside of 5 years for something like this. So when the demand is just going basically off the charts here, you can really fill the capacity very, very quickly. In fact, our New York wafer fab that we put a shovel in the ground in March of 2020, and we're just starting to open it up right now, is essentially sold out.
Greg,
and it is the world's largest factory.
To me, all of this comes in the face of so many calls from market prognosticators of recession imminently, of the idea that people are going to slow consumption. How much does that contrast with what you're seeing on the ground?
Well, we have kind of a unique situation. We have a secular growth story that basically is going to be unstoppable. What's happening is the adoption of electric cars is happening at a substantially faster pace than anyone anticipated. And the adoption of silicon carbide inside of electric cars is happening at a substantially faster pace. And so, we've got this 60% compounded annual growth rate. We don't see that slowing down. And by the way, silicon carbide enables two important things in an electric car. The car will go further with the same battery, 5 to 15% further. It's a huge deal with range anxiety. And the second thing it enables is faster refueling. So the charge time goes way down. I can charge my car. In 20 minutes, I get 250 miles of range. That's pretty good.
Greg Lowe, thank you so much. With Wolf Speed, greatly appreciated this morning here. You dovetail this with Adam Posen's most talked about essay right now, and it's just not that simple. People want to do simplistic analysis here, and it's just off the mark. I mean, it's just all there is to it.
It's interesting, though, to hear about some of the specific businesses. And Greg was talking about some of the resilience of his business. And then you wonder about the hiring prospects for a lot of these companies that are trying to expand at a time where it's so difficult to hire, particularly in some of the factory jobs that they're looking to expand in. And this has been some perennial concern. Okay, we have this plan to dramatically expand our tech manufacturing, but we don't have the people.
Well, what I'm going to go to, and I went with Dr. Posen on this yesterday, completely opposed to what we heard there, I should suggest. And we mentioned William Klein, who was a huge influence on me. William Klein is with the Peterson Institute, where Dr. Posen is. And he always emphasized in his research, Lisa, that looking at a bipartisan or two-part analysis was naive. And so if we're going to put an Intel factory plant somewhere in the United States, that sounds like a great idea. But it's not just about that factory in China, and that bouncing off that are all these adjacencies, including Latin America and in Europe, frankly. It's a huge adjacency issue here that makes this discussion more complex than the certitude. Certainly, to create jobs in any of the Carolinas sounds like a good idea right now.
Well, and it's something that a lot of people will welcome. Taking a step back, remember when we were talking about a secular increase in inflation, that it was going to be stickier? And then all of a sudden people are saying, it's going to go down by itself. And we just basically missed it. And it was just a distortion from the pandemic. And that, I think, is sort of the angst underpinning business decisions, as well as what you're seeing in markets right now, is that this is a tipping point. We're not sure what we're going to, because this is a regime change, and we have seen that dramatically. And the data is not giving us clarity at a time of incredible change and incredible interest rate hikes.
You sound like Romer, the laureate, Paul Romer. I'm going to cut to the chase on this, and that the great mystery here, and I'm not talking about 1 year. I'm not talking about where's my portfolio in 3 years. I'm talking about someone's lifetime, or at least our kids' lifetime, is the technology overlay. Now, what Greg Lowe just talked about there is part of that technology overlay. But there's this immense unknown. My answer is, and I don't want to editorialize here, but John would say, yes, you are, Tom, so let's go there. We miss John so much. But the fact of the matter is someone's going to be a technological winner and a technological loser in America. And the real issue is how to drag those technological losers along and allow them to prosper in this new America. We're not there yet, and we don't know where we're going on that.
Right, and we don't know exactly what the new technology will be. Just another note, you asked me earlier whether the primary market in credit was still closed. It is not, and you actually see about 13 companies coming to market.
Did I pick that? Thank
this
you.
week.
Thank you. I don't want to editorialize, but
you don't want to take all credit.
Please, I want to take. I'll take another
week.
We'll
carry
off.
that conversation forward coming up on The Open with Aaron Kennan, co-founder and CEO of
nice
Clear Harbor
security.
Asset Management. We also have Eric Nelson of Wells Fargo and Emily Hill, CEO of Bowerstock Capital Partners. So really talking about this dissonance that we keep seeing between bonds and stocks. This is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Bloomberg Surveillance, Jonathan Farrell, Lisa Bramwitz, and Tom Keene. John Farrell on assignment. He may be here tomorrow, maybe the next day, I'm not sure, but we're looking forward to his return. Lisa Bramlett's getting ready to drive the conversation forward this morning. Red and green. Now, a little bit of red on the screen here, a little bit of angst out there, but I'm not going to make much about it. That 2-year yield we're following, 4.00%, 10-year yield 3.54%. We are going to take inventory of the economic statistics right now and get a brief on the week with Michael McKee.
Inventories are out, Tom. This is a week of tertiary indicators. We're not really getting a lot of stuff that's going to tell the Fed a lot, but we do see retail inventories up 0.8 after a 0.3 gain in the month of January. It does suggest there's some stuff to clear out, but do we see any prices drop because of it? That'll be the follow-on question. Wholesale inventories up 0.2% after a 0.3 decline the month before. This is probably related to China and the Golden Week and the sort of disruption of the trade flows during that time period. We also see that the advanced good trades balance is out negative $91.6 billion. And that's up from negative 91.1. So a little bit wider trade deficit for the month of February put a little pressure on growth. But
what does that mean right now? The trade deficit is the back end of the equation. Exports take away imports as well, which means there's also a domestic measurement of the economy. How is the separation of two? Where does that stand right now in a 3% GDP?
Well, the simplest way to put it is that if you're buying stuff from overseas, you're not buying stuff that's made in the United States. And we do seem to be buying more from overseas these days. Now, that is hard to tell. It's either because the economy is strong and people want more stuff and the U.S. can't produce it, or because the U.S. is not making stuff that people can afford and they want a different kind of mixture. But that's something economists try to figure out going forward. Really, this week is a bit more about the banks and the Fed speak, although even for Fed speak, it's not going to be
we can do this. I mean, McKee's been doing this for so long, we can rip up the script and he'll always be. But I was going to go into economic jumble for the week. Let's go to the hearings that we'll see today. From a Fed standpoint, what is Mr. Powell's best outcome of those hearings?
At this point, probably if Vice Chairman Barr can convince them, along with the FDIC and Treasury representatives, that Congress should look at an overhaul of the insurance limits and the law that enables them to bail out. Excuse me.
We're all coughing.
I got whatever you got.
We're going to get a floor manager's going to cough. 2 camera guys over here going to cough. Let's have a group cough. 3, 2, 1.
Everybody together.
There we go. Nobody has COVID. Good.
But there's a concern in Congress about whether the Fed and the FDIC overreached, and they really are using the powers that are in the law to do what they felt was the best thing in the short run because they couldn't know what else was going on. So once we lay all this out, it's time to then think about how you manage the U.S. system. And this would be a huge change to insure deposits, all deposits. Obviously creates moral hazard questions, but it is something that only Congress can really decide. So that would be the best and most important outcome here.
Michael McKee with us in a hugely busy economic week. He says tertiary data. I would say Case Shiller that we see out later.
Friday we get income spending and the PCE index.
The PCE index.
The problem is the next Fed meeting isn't until May 3rd. So this data isn't going to make a lot of difference in what they are going to do.
We'll take this up and wrap it together on a global basis with Jay Bryson, Chief Economist at Wells Fargo. Thrilled that he could join us this morning. Jay, so many people are looking at the non-recession call wrong with the 3% real GDP growth right now. Give me some color about what the next quarter or the rest of 2023 looks like.
Well, Tom, I think it's going to be slower. I mean, our sense still is that the U.S. economy by the third quarter of this year will be in recession. I think it's kind of a slow-moving, I'll call it train wreck, if you will. It's not going to be anything sharp. But, we have rates that are elevated, and you have the lagged effects of that. And now on top of that, you probably have some sort of credit tightening that's going to be going on in the nation's banking system, given what we've seen recently. And all those things, I think, put headwinds on the U.S. economy, and it causes growth to turn negative in the third quarter of this year. But we're, at this point, we're certainly not there yet.
Can we say that there's, John Edwards, that there's two Americas? There is an America prospering, or at least not in recession, clearly evident by windows of consumption that we see. But is there another America out there that's just not prosperous right now? Can you suggest at Wells Fargo that there is two Americas in a disparate economy?
Well, I think that's always been the case, Tom, in the sense of who gets hurt most during slowdowns or downturns. It tends to be blue-collar sort of workers, or at least historically that's always been the case. And even in the worst part of a downturn that we saw back during 2010, unemployment rate goes up to 10%. You still have 90% of the workforce still working in that sort of environment. So I think we've always had that. More recently, if you look right now, what sectors are weaker? It would be manufacturing. That's probably flat at best right now. And, housing is also taking it on the chin a little bit as well. It's the service sector that's really holding up right now.
When I got Jay Bryson and Michael McKee on the same set, that is a good and beautiful thing. Jay Bryson, we're going to go to handsome Michael McKee here, and he's going to frame out what you write about, which is the crazy dots. I don't like the dots, Michael McKee. Jay Bryson's going to comment here on the dots. How unusual are the dots, Mike McKee, right now?
Well, a lot of people commented on 24 and 25, the fact that they're very, very dispersed. And that's not an unusual thing, especially for 2 years out. But, Jay, do you think that the Fed, like most people at this point, is very uncertain about what's going to happen over the next 2 years, and we really can't read a whole lot into what they're telling us about what they think is going to happen?
Oh, I think that's dead on, Mike. I mean, if you look at the most recent statement, they came out and they said, they think that what's going on in credit markets right now is going to have a slowing effect, but they said, but it's hard to tell right now exactly what. And so for each of those dots, I mean, I would say there's probably a pretty big confidence interval, area of uncertainty, if you will, around each of those dots. At the end of the day, each FOMC member has to put down where they think the rates will be at the end of this year. But I think for all of them right now, just given what we're going through, there's a lot of uncertainty around each individual dot. And then you see it next year with just the wide dispersion, in terms of the end of 2024.
Well, with the dots this time, they said basically we're not changing our view. We're going to have to raise one more time. Do you think they actually get there? I was just talking with Tom about how May 3rd is the next meeting, long time away, a lot of data to go. Are we going to get a rate increase on May 3rd, or is the data and your sense of the economy leaning towards it not happening?
So, Mike, I guess what I would say is I think it's predicated largely on what happens in terms of markets in the coming, month or so. I think at the end of the day, what the Fed feels relatively confident about is they can handle what's going on in this situation. And if everything kind of calms down, then I think by the time the FOMC meeting rolls around.
Okay, I guess I lost some audio there. We're trying to figure that out right now. I believe we lost audio with Dr. Bryson of Wells Fargo. We'll continue here and welcome all of you on radio and television. Mike McKee, I'm going to go to you on the question I was going to ask Dr. Bryson. He taught in Alabama. To the east is the Georgia School of the legendary Richard Timberlake. Robert McTeer teaching there, or studying there as well. The Georgia School, almost, folks, is a school of thought that reaches out to the Dallas Fed. Okay, fine, but I just wonder if the Georgia School would suggest the dots have been efficacious, or have they not?
It's a question that people in academia will debate. But the Fed argues it is because it gives some forward guidance, and it puts context around their forecasts for what's going to happen to the economy.
Yeah, but you're in the trenches on this. Have you seen them be efficacious, or are they just part of the parlor game?
I think overall it may not have been helpful. I can't say I'm a big fan of the dots, because the problem is there are, when there's a full complement of Fed officials, 19 separate dots. But the market tends to take them as one dot. The consensus median as a Fed forecast for what they're going to do, and it's not really that at all. So it does kind of get the Fed in trouble, and we've talked about this before. You get later into a quarter or into a quarter after they have put out a dot plot, and everybody says, well, the Fed's behind because they think this. Well, their views have evolved. They just haven't put out a new dot plot yet.
Right. Jay Bryson, thank you so much for being with us as Wells Fargo. We've lost him on technical difficulties, and we'll continue here with Mike McKee. You mentioned Friday being important. Let's go back to McKee 101. boring CPI at the grocery store, inflation here, maybe producer price indexes, the price of used cars, real estate is the worst it's ever been, and yet there's this fancy thing, the PCE deflator. What is the PCE deflator that's important for Mike McKee?
Well, it's basically the inflation numbers that the government uses to adjust GDP for inflation and to take out what the, just price changes mean for that. But it is the Fed's favorite indicator. They feel it more accurately represents
than CPI
what people spend on a regular basis, and so that's what they tie their 2% target to. So we all talk about the CPI on a year-over-year basis, but it's the PCE, which on a headline basis is 5.4% lower than CPI, but it's still too high for the Fed. But that's what they're looking at. So the fact when we get it on Friday, that will make be something they want to see.
Year over year, PCE core deflator surveyed to be unchanged at 4.7%. Do you suggest we can get that back to 2-ish? Is the policy verbiage? Or does Mike McKee have a new set point somewhere above that?
It's going to be an interesting question to see if they can do it. Their feeling is they have to promise to do it. They have to try to do it, or they lose credibility with the markets. But can it be done? That's going to depend on whether the economy has evolved back to sort of the old normal, where there is a certain amount of inflation, and it could be 3%. It's been said many times, 2% was not a magic number. It's just a number that most of the world's central banks have landed on as a decent figure to aim for in a world of zero interest rates. But now we're not there anymore.
We'll see, Michael McKee. Thank you so much. Here, the first economic data of the week, and we'll continue to that important data on Friday. What am I watching? Two-year yield back under 4%, now 3.97%. A little bit of red on the screen. Stay with us on radio, on television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Police in Nashville, Tennessee say the shooter who killed 3 children and 3 adults at a Christian elementary school may have been an ex-student. Audrey Hale was described as a 28-year-old white Nashville resident who identified as transgender. Hale was shot dead by police. Did the Federal Reserve do enough to oversee Silicon Valley Bank, the lender that collapsed earlier this month? Well, that's what a group of Republican and Democratic senators want to know. They've sent a letter to Fed Chair Jerome Powell asking if the central bank exercise its full authority to supervise Silicon Valley Bank and other mid-sized banks. In France, unions are holding another nationwide day of strikes to protest President Emmanuel Macron's unpopular pension reforms. Union leaders are calling on Macron to negotiate. Last Thursday, protests ended in chaos, with some hardcore demonstrators fighting with riot police. And Google has asked a federal judge to dismiss the U.S. government case over dominance in the digital advertising market. Google argued in Monday's filing that the case ignores the company's biggest rivals in online advertising. The lawsuit calls for breaking up Google's ad technology business, one of its main sources of revenue. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You should be more positive equities now than a month ago. This bank scare, and I use that word rather than crisis, I think that accelerates everything we were expecting this year. I think growth is going to slow faster, inflation's going to come down faster, and interest rates are going to come down faster.
Ben Laidler leading off our coverage yesterday, global market strategist at eToro, I should say, there on his enthusiasm for the equity market is something that's off our radar in this bank crisis. And of course, those hearings today. Amory Horder and Joe Matthew tonight, balance of power, look for that. Very much looking at the effect of these hearings. Maybe the first salvo of what we're going to see for months and months. Futures -8. Dow futures a -40. Right now, I just want to digress. I am a member of the CFA Institute. Everyone knows I'm as biased as can be about the gloriousness that comes out of Charlottesville, Virginia. There has been a comic joke for years that I've always preached that we really, really need CFA level 4. It is 3 tests, 1 test, level 2, level 3, and that's it. And we need a level 4 exam just to increase the pain. What we know is it has evolved to be a world exam that had to deal with a pandemic. And the real news and the results today that our Catherine Doherty reports is a nice pandemic recovery in the success rate of those initial level 1 pass rates. It ticks up, getting up near the classic 41% level. I should mention as an aside, there's a raging debate right now in the CFA as they rejigger the program because of the length of studying and maybe what we'll see in the new CFA down the road. It's just great to know at Bloomberg there's so many people that have participated in the program. I know Romaine Bostic is involved in the program and many, many others as well. So there's CFA level 1 out, pass rate ticking up, which is always constructive. Not ticking up is the success in crypto of the dominant player. It is Binance, and I started screaming about 2 a.m. this morning. Where is she? Where's Greifeld? Get Greifeld out here to finally explain what I knew was finally coming, and everybody said no. Binance, the U.S. authorities are going after this big dominant global player. Why is anyone surprised? I've been waiting and waiting and waiting for this moment.
Tom, to your credit, you've been asking me for months what is going on with Binance, and I haven't had a good answer, but now we have a good answer. This coming from the CFTC. This case is basically about letting American customers, this is what they're alleging, use and trade crypto derivatives. You're not supposed to be able to do that if you're an American customer. So that's at the heart of this case, that basically it was instructing Americans to set up VPNs, virtual private networks, to be able to trade derivatives on Binance's platform, which is not based in the US. So that's at the heart of it. There's also a second part of it here where it was directing its VIP customers, which you can read basically as big market makers, to open Binance accounts under the name of shell companies. So the CFTC said that they've been looking into this since at least 2021. Right. So this has been a long time coming.
Are they front running the SEC on this? I know there's always tensions between Washington and Chicago. Explain the dynamic here of CFTC versus SEC and this ginormous crypto player.
That's an interesting detail that this was coming from the CFTC. I was a little bit surprised, and I read that headline twice. But basically, because this is about derivatives, this is coming from the CFTC. The SEC has been looking into Binance, but specifically about whether it supported the trading of unregistered securities. But because this concerns derivatives chiefly and what American customers are doing with them, that's why this is coming out of the CFTC.
So Binance goes, okay, fine. We don't need American customers. Did they just pull away from the Western Hemisphere? Do they just pull away from the United States and even Canada?
That's sort of the overarching narrative, is where does this leave the crypto industry when it comes to the U.S.? It's very possible that we could see Binance just continue to focus on its overseas operations. But at the part of it is that if you think about the large market makers, the institutional market makers, they're really based in Chicago and they're in New York. And if you're a Binance, you want those market makers on your platform.
Some names of those, are they like the Winklevi twins? Are they market makers? Who's market makers in this stuff?
I mean, think about Jump. Obviously, Jump has had a lot of, forays into crypto. Jump isn't specific to this case necessarily, but if you just think about the heft of the market-making institutions, what really powers some of these equity markets and the crypto markets, a lot of them are based in the U.S.
As a complete hack, I would have said with these headlines, Bitcoin would have gone down X amount. It didn't. It's been resilient. Has it surprised you?
I know. It went down a little bit yesterday on the back of these headlines, but we're sitting at 27,000. We got as low as, 15,000 months ago. But that's the thing, is that Bitcoin has been very resilient. At the same time, you have seen liquidity really drop off. There's some firms that track this. According to Keiko, you can see Bitcoin liquidity is at 10-month lows. So we are seeing this resilience, but that might be because no one's really trading
who's on the bid? I mean, to cut to the chase, who's on the bid? I mean, for the Gloom crew, Nouriel Roubini out on Twitter today has just been, really, really strong language from Nouriel Roubini, who's a crypto skeptic, to say the least. Who is on the bid on Bitcoin? It's not mom and pop on their couch, is it?
It could be. I mean, it's probably not institutions. Remember when the whole thing was, this institutional embrace of crypto, Wall Street coming into crypto? Now I think you'd be hard pressed to find a corporate treasurer who's even thinking about adding Bitcoin to their balance sheet. I mean, you do have some of these professional money managers, these asset managers, thinking about how to offer access to crypto for their clients, but this sort of big Wall Street embrace of crypto has really gone away. And what you're left with is a lot of true believers, people who bought Bitcoin, 5-10 years ago.
So you're telling me that 60,000 to 15,000 with a nice bounce, some enthusiasm, to 27,000 is a true believer bounce?
Well, in terms of what got it up to 69,000 or wherever it was, that was a lot of retail coming in. That was a lot of institutional investors thinking about it. And just the promise that you had people
That's what
thinking
BIS says.
about
Bank of International Settlements folks on this is adamant. They say that's exactly what it was to 60. We're not there anymore.
We're not there anymore.
15 up to 27. Now what?
Well, when you see retail come back in a big way, when that happens, I don't know. What this is, I've been saying for months, it's a macro asset. You think about where we went from 69 down to 15,000. You're narrowing your eyes, but I swear to God, this is such a good measure of risk appetite. It trades like a leveraged tech stock. And really what we've seen, that big line down on the chart, that was basically what happened to tech stocks, but more dramatic.
But who's trading? You're telling me Bitcoin is trading off the NDX, the NASDAQ 100?
Not that there's like a direct link there, but in terms of sort of the risk sentiment that really gets crypto going. When you see tech stocks rallying, you often see Bitcoin rallying at the same time.
Yeah, I see that. I see that. But you're telling me liquidity is not there. That liquidity right now is very low. Volume's low.
Liquidity is very low, volume is very low, but still you see this more often than not. This asset class tends to trade alongside tech stocks.
Because I'm blown away by the resiliency of it, given this momentous CFTC Binance announcement. I mean,
you
am I
could say
wrong?
the same about the NASDAQ 100, where whatever is happening in the banking sector right now, whatever shoes may fall. I mean, the NASDAQ has been really rallying. Big tech has become the haven. And for better or worse, you have Bitcoin rallying as well in light of whatever's going on in the industry.
Is our global team seems reporting that Binance responds to these allegations today. Is there a news element in the next 24 hours?
If you look at the blog that they posted in response, it does seem that Binance is going to fight this. They talked about how they don't shy away from challenges, so expect a response from Binance. It doesn't seem like they're just abandoning the U.S. entirely.
We're not going to abandon this story. Greifeld, steeled for the crypto show. It happens to be Tuesday. Look for this, Binance on Bloomberg Crypto today at 1 p.m. This is with Matthew Miller, Kaylee Lines. Maybe Greifeld parachutes in for a cryptic crypto moment here. But anyways, this is real news. I've been looking for this for weeks and weeks, and it's a story worth following. Thanks to our team for the brief there on Binance. What I'm going to do in the final minute here is on a Tuesday, remember that Michael McKee exists, and we're launching into economic data. Granted, he says it's tertiary data until Friday, and the fact is we'll have to watch that data because we're still data dependent, and part of that data will be deposit flows from a challenged American banking industry. We're certainly going to see that in the banking hearings today. Not data per se, but at least the emotion will start to come out. I really urge all politics of it in the back and forth, but the actual observable data we see on a data-dependent American banking industry, and certainly, as we always do here on surveillance, to look at the data dependence of the American economy and indeed around the world as well. Special thanks today for Stephen Engel, late in his Hong Kong there on Alibaba. Futures -8, Dow futures at -41. I had to do that for Victoria Hernandez. VIX 21.07. This is Bloomberg.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Just to add to my anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, the Fed is explicitly trying to boost unemployment. It seems like that is probably the worst environment for, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American at this point, or anti the American dream, right? Housing more expensive,
crushing the housing market,
crushing demand, crushing the labor force. What are going to be the social consequences of central banks, having to do this in order to put a cap on price increases?
They're going to be severe. We're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, laissez-faire policies, because there has been a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world, and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A bit of softness, basically range-bound here as we count down to the open, which starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, stocks on hold, treasuries extending their declines as traders continue debating the Fed's next move. And the banking crisis comes to Capitol Hill. Let's begin with the big issue, recession fears versus rate cut hopes.
Right now, the markets and Fed are playing a game of chicken.
I have heard a lot of people thinking that we are going to have rate cuts.
The market has anticipated a lot of rate cuts this year.
The market's pricing in, give or take 100 basis points, of rate cuts by the end of the year.
The bond market is somewhat, dismissing the Fed's dot plot.
Rate cuts are being priced because there's a significant risk of an economic shock.
I think recession probabilities have probably crept up.
Global economic growth is decelerating and a recession is likely to play out.
If the Fed really sees a recession coming, they're going to do something.
The bond market is sort of jumping ahead of what the Fed is saying.
When you think about the Fed and all of these, they've still got a big inflation problem.
There's a huge gap, a huge spread in the views out there.
So basically trying to put it all together and make sense of us is Clear Harbor's Aaron Kennan and Eric Nelson of Wells Fargo, who are going to tell us what to expect in a wash of absolute uncertainty. I really want to start with this one question, though, for both of you. Are rate cuts good or bad for risk assets? Aaron?
Well, that's a great question. They tend to be better for the longer duration part of the risk asset space. So, sort of the growthier components of the equity market. When you have markets trending lower due to credit tightening concerns, a banking crisis, and the potential for a pending recession, it would seem as though that sort of long duration equity rally could very well be short-lived. But it's interesting also, Lisa, to see equities trading roughly today where they were just prior to when we started hearing about Silicon Valley Bank.
Basically, and this is really, Eric, I would love to get your take on this as well. There is a feeling that we are no further away from a soft landing when it comes to stocks than we were before Silicon Valley Bank because of some of the rate cuts being baked into market expectations. Do you take issue with where markets are right now?
Well, Lisa, I think it's the biggest issue I take is how quickly the market is pricing the cuts. I think it's very hard to sit there in front of someone who's actually holding risk in this market and say, the Fed is not going to cut rates and you should not be pricing that. I mean, there's obviously a lot of recession fears out there. There's a ton of uncertainty over the banking sector. So even if you think the Fed won't be cutting in the next 6 or even 12 months, there's a risk that more cuts get priced in the meantime as the turmoil picks up again. But again, I think the Fed, the bar to cut will be higher in our view, and also the time sort of with which the Fed will be sort of eager to cut will also be longer than in prior cycles. So what we're seeing today is those cuts being pushed out, so back toward the back end of 2023 or even into 2024, which I think is a sensible thing to do right now. Ultimately, we do think the Fed is going to be, again, very cautious in sort of moving toward a rate cut. So those hopes for a cut, I think, will be take a very long time to actually be vindicated. And so for right now, I think the trade is to see those cuts being pushed out as opposed to being priced out.
Well, I think that a lot of people would agree with you. BlackRock Sway Lee among them. She wrote a note for BlackRock saying that, quote, that's the old playbook when central banks would rush to the rescue as the economy, as recession hit. We see a new, more nuanced phase of curbing inflation ahead, less fighting, but still no rate cuts. Right now, the market is pricing in almost a full 1 percentage point of rate cuts by the beginning of next year. Aaron, from your vantage point, how much is this an opportunity for you to push against the market pricing and say, okay, this is illogical. We are going to see something else and capitalize on it?
Well, it's interesting. I think the Fed is sort of, there's a conundrum that they're faced with, which is, they see a lot of the headline inflationary pressures decelerating, and we all sort of applaud that. but we look at the wage picture, we look at the overall employment picture, we look at the labor participation rate, and it's not back to where it was even pre-COVID. And so I think that the Fed is very much of the view that they really want to slay this inflation dragon. And I would argue that it's even more imperative in 2023 they do it than in the early 80s, because debt to GDP at the public level was 120%. Back then it was 35%. So every 1.5% rise in the weighted average cost of capital to our deficit adds about $450 or more billion of interest. And so in some sense, I think the Fed needs to slay inflation, which is why it's been the most dramatic, most quick tightening cycle that we've seen over the last 7 cycles since 1983. And so it's sort of interesting to see that ultimately where they want lower inflation, and they need it quickly, but they need to make sure that they fight it hard in order to get there.
Yeah, a lot of people don't believe that they're actually going to do that, I think, which is one reason why you do have this reduction in interest rates that's sort of being baked into the market. A lot of people, though, also saying that the chance of recession, yes, is getting higher, but still isn't the base case. Goldman's Jan Hatzius among them seeing perhaps a 35% chance of recession in the next 12 months. He writes, quote, reduced credit availability will prove to be a headwind that helps the Fed keep growth below potential, despite the support from rising real income and better global growth, not a hurricane that pushes the economy into recession and forces the Fed to ease aggressively. The risks are clearly skewed toward larger negative effects. So, Eric, from your vantage point, do you think that this is accurately priced into risk assets at this point, that yes, we may avoid recession, but it will be a slow growth kind of environment for a pretty long period of time?
Yeah, well, Lisa, you've made the important point about the optimism that the Fed will be quick to cut rates, and that's a huge assumption that the market is making right now, and that may end up proving ill-advised. So what concerns me is that you may start to see growth really deteriorate, labor market deteriorate, and the Fed be very cautious about cutting rates. So that usual interplay between recession, lower rates, risk assets may not play out exactly the same way as it has in the past. And so thinking about sort of the read-through to other assets, you look at, for example, the question of QE, I think, is also really important to keep in mind as well. Will the Fed be quick to expand its balance sheet, not from something like BTFP, but more from something like QE? If they're hesitant to do that as well, then you start to think about even steeper curves than you would typically see in a recession scenario and other sorts of dislocations relative to past cycles.
Well, let's talk about Fed speak. We're going to get more of it, and economic data as well coming through the week. Let's get to Michael McKee to get a sense of what's on deck. Mike.
Well, Lisa, we're probably going to have a lot of Fed officials talking back to the folks you've been having on the show lately, saying that the Fed is going to be cutting rates, because the Fed's not going to be cutting rates, at least according to them. A lot of Fed speak this week. We've got Jefferson yesterday, didn't really address it, but Barkin, Collins, Kashkari, Williams, Waller, Cook, Barr before the end of the week. And those who are talking about monetary policy expecting to say we still need to focus on inflation. The banks are one thing, but inflation is the issue, and we're going to keep rates where they are for a long time. Now, Michael Barr is not going to be talking about that. We know he's going up to Capitol Hill today to talk about the bank situation. Here's the bank situation as far as the economy and the Fed are concerned. You can see how the blue line shows that many banks have tightened credit standards already. And this is February data. We don't have the latest loan officer survey, but those in the white line who have tightened it a lot, very small. So does that number go up? And the yellow line, that's commercial and industrial loans that we have been seeing from the banks in America. And even though lending standards have tightened, you can see that lending has not. Rest of the week, we've got nothing really until Friday. Personal income, spending, and the PCE inflation numbers, those should reinforce the Fed's message. But the Fed's meeting isn't until May 3rd, so it's probably not going to matter as much as the data we get between now and then, particularly on what banks are doing with lending and whether that actually is a problem.
Michael McKee, thank you so much. And that really is a problem as well when you've got a Fed that's data dependent and then an absence of data at a time when people are so clearly trained on bank issues. Aaron Kennan and Eric Nelson are still with us. Aaron, from your vantage point, how much are you seeing the recent stresses in the financial system as a game changer, as potentially accelerating some of the slow growth that people have been talking about for a while?
Well, it's certainly helping the Fed do, some of their work. If you look at the dot plot, they were at 5.6% for year-end terminal rate 2023, and this time around, that was back in December, and now they're at 5.1%. And so it's almost as though they're pricing in, the fact that this banking crisis is tightening financial conditions without them having to do anything. And so some estimates are that conditions have tightened well over 100 basis points. And so I think it just accelerates and raises the probability of a recession. You're tightening lending standards. 70% of consumer loans occur at the regional bank level. There's a lot of uncertainty there going forward. And you look at the inverted yield curve, and yes, it's less inverted now than it was back in early March, but that tends to be the case as you're entering a recession where the curve becomes far less inverted. So I wouldn't necessarily view that as a silver lining for those who think we're going to avoid a recession.
There's also a question about what is the next shoe to drop. And Eric, from your vantage point, do you see another likely crack likely to emerge as some of the lag effects of rate hikes start to take hold?
Well, the first point I want to make, Lisa, is I'm not necessarily sure this current U.S. banking sector issue is fully resolved. We still have questions over some of the back and forth we've heard from the Treasury on deposit insurance, whether or not all deposits will be guaranteed. And there's also some hope and optimism out there that the Fed and regulators will enhance the existing liquidity tools in order to support the banking system. But that actual action is still forthcoming, and we're not sure exactly what could trigger it. So I'm not ready to put this current crisis behind us. The other point, I guess, would be in terms of what comes next. In the U.S., we've had a lot of questions about CRE and office lending, and I think that's something to certainly watch for, but probably over a longer time frame. I do worry about a couple of other things, and one in particular would be in the Eurozone, looking at the peripheral bond markets. Certainly something to watch here. But for right now, I think that the acute issue in the U.S. banking sector, to me, is not fully resolved yet where we can put it behind us.
So, Eric, what are you looking at in particular for a possible next step in this issue that has yet to be resolved?
Well, certainly Barr's comments today will be very interesting, and I do suspect he will be pressed on questions over deposit insurance and how the recent sort of issues around the banking sector have been resolved, and what that means for the playbook going forward. So I think it's certainly an important day today, and really want to getting a sense of, how is the market behaving around some of these banking, whether it's in the credit market and the equity market. That's what I'm watching most closely, as opposed to necessarily looking at the typical indicators like Fed pricing or what FX are doing.
We were talking about this last week, that perhaps the Fed is looking at bank stock as one of their data to be aware of and dependent on. Aaron Kennan and Eric Nelson, both of you are sticking with us. Coming up, day one of the Silicon Valley Bank hearing.
There's got to be an explanation as to why the San Francisco Fed overlooked all of these flashing signals. I think there's going to be very tough questioning. The credibility of the Fed is on the table today.
That conversation coming up.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country? Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think this hearing matters a lot. There's got to be an explanation as to why the San Francisco Fed overlooked all of these flashing signals. I think there's going to be very tough questioning. The credibility of the Fed is on the table today. Obviously, Michael Barr will be a key player. But again, I would just reiterate, there were flashing red signals that the San Francisco Bank, which had a very cozy relationship with the Silicon Valley Bank, just chose to ignore.
Financial regulators back in the hot seat as lawmakers begin their investigation into SVB's collapse. First up, the Senate, and in the line of fire, Fed Vice Chair for Supervision Michael Barr, the top central bank official looking to reassure Congress of the country's, quote, sound and resilient banking system in his prepared remarks, calling SVB's collapse a, quote, textbook case of mismanagement. This coming as the Fed chair gets his own call from Capitol Hill. Senators sending a letter to Powell questioning whether the Fed has used its full powers in supervising lenders. Team coverage of this incredibly important hearing starts right now. Bloomberg's Anne-Marie Hordern alongside Kaylee Lyons down in Washington, D.C. Kaylee, I want to start with you. Right, we are looking at the hearings that are set to begin, I believe, in about 45 minutes' time. What is the tone? What is the goal of these particular proceedings?
Well, the goal of this hearing is to unpack what happened and why, and what regulation and supervision may need to change in the future to prevent something like this from happening again. These three testifying today are going to be facing some very difficult questions, particularly the Fed's Vice Chair of Supervision, Michael Barr. As you were just illustrating, a lot of question around what supervisors knew when. He does address that in his prepared testimony that was released yesterday. He said that staff were actively engaged with SVB, but ultimately the full extent of the bank's vulnerability was not apparent until the bank run actually happened. He also goes into detail around that 2018 rollback of certain Dodd-Frank requirements and says that the Fed is looking into how more stringent measures being applied to SVB may have prevented its failure. That is also a subject touched on by Marty Grunberg, the FDIC chair, who basically says that these failures show that banks with $100 billion in assets do have implications for financial stability, and as a result, prudential regulation of these institutions merits serious attention. So it's going to be a lot of conversation about how regulation and supervision need to change to prevent this in the future, but also how do you stem the bleeding right now as we are still concerned about deposit flight from smaller institutions to those deemed too big to fail, which is where the question of the FDIC insurance cap comes in. Should it be raised? To what level? Should it be lifted indefinitely? For what period of time? Those are going to be the kind of questions faced by those testifying today.
A lot of people also looking to what kind of policy response is implied by the questioning, implied by the aligning of different camps in Congress. Anne-Marie, what are you learning about what the camps actually are, what some of the politicians are hoping to get out of this?
Well, listen, what this is going to be is a hearing with a lot of questions, but also, Lisa, a lot of statements. You have some of these senators that are up for re-election next year, like Sherrod Brown, the chair, very hard re-election. Senator Elizabeth Warren, she re-announced her campaign yesterday. So they're going to take a lot of this in a partisan view. The Republicans want to point to supervision. They also want to blame the president for bailing out what they call a quote-unquote woke bank. And then you have the Democrats who are really going to want to talk about the rollback of some regulation, that Dodd-Frank regulation under the Trump administration. But remember, Lisa, there are moderate Democrats who voted for this. So there's really not a consensus yet of what potentially lawmakers can move on.
All right, Anne-Marie and Kaylee, thank you so much. We'll be catching up with you throughout the day. As we do get this turmoil in the banking sector, it has kept J.P. Morgan defensive strategist Marko Kalanovic laying out his rationale, writing, quote, first, higher uncertainty should put upward pressure on risk premia embedded in asset prices and increase the need for precautionary savings among investors. Second, economic forecasts have a long way to downshift to catch up with markets. Still with us is Aaron Kennan and Eric Nelson. Aaron, what I'm struck with is, yes, on one hand, you could have constrained lending. On the other, it is clear that even smaller banks are systemically important, at least as defined by needing a bailout or needing some sort of intervention. And there seems to be an implicit support for the financial system. So where are you looking for nodes of stress that could potentially pressure equities in a more substantial way?
Well, when you essentially tighten lending standards within the banking segment that caters to small businesses and consumers, you know, you're ultimately statistically increasing the likelihood of recession. And usually there's a lag effect by about 3 or 4 quarters. So if that's sort of happening or has been happening over the last quarter or so, and particularly right now due to the banking crisis, we think by mid-year later this year that the risk of recession is significantly elevated. But let's not forget, too, you know, they're meeting in D.C. today and they're talking about regulation. You know, at the end of the day, to me, there are 2 things to consider. One is the diversification of deposits and the sectors that they represent in industries. In this case, it was very tech sensitive. But the other is traditional banking is about lending, borrowing short and lending long. And when you think about that, the only way to sort of rectify that is to not borrow, not lend as long, to sort of like turn a bank into an insurance company, to really match your duration. And if you do that, that means you're going to have significantly higher loan rates, significantly higher mortgage rates. I think that's politically untenable too. And so that's the dilemma that will be faced by politicians. They won't say that, but that's what we should be thinking about.
You can feel it right now with the letters that they're getting from their constituents saying, don't let our banks fail, while also saying we're not going to bail them out because we don't want to be accused of bailing anyone out, kind of stuck there between very different kinds of goals. Aaron and Eric. Eric, I'm curious from your vantage point how much you've brought forward your expectations for a recession as a result of what we've seen over the past 3 weeks.
Well, Lisa, I have to give substantial credit to our economics team, which has been calling for a recession to start around Q3 for the last 6 months or so. Maybe that we bring that forward a little bit, maybe by 2 or 3 months toward the middle of the year, but these things still take time. We still have not seen jobless claims move up hardly at all. The Challenger job cuts do point to some jobless claims in the pipeline, but it could still be a couple months before we start to see real significant turnover toward weakness in the labor market. And that's going to be a challenge for the market that is really waiting for the next immediate catalyst to trade on. Like I mentioned, the banking sector issues may not be resolved in the short term, but trading the recession could be frustrating for people waiting for something to happen imminently when really the business cycle dynamics do take quite a while, months if not quarters, to play out.
There's also a question of whether, if this doesn't take hold in terms of tensions, we end up with a bigger potential problem with inflation. Eric Nelson, thank you so much. Aaron Kennan, you are sticking with us through the opening bell. Coming up, the morning calls and later retesting the lows. Why Bauer Stock's Emily Hill thinks the S&P can go as low as 3,200 in the first half. That conversation happening around the opening bell.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. After yesterday's somewhat constructive tone to markets, we're seeing a bit of softness, but not much. The interesting thing is the S&P and the NASDAQ are down about the same amount, despite some of the underperformance of the NASDAQ yesterday, a departure from what we have seen over the past few months. In the yield space, you are seeing yields just a touch higher. The underperformance coming from the long end of the curve, the idea being potentially people are getting a little more worried about inflation over a longer term if they start thinking about rate cuts in the near term. Time now for our morning calls. Some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo upgrading Carnival Cruise to equal weight, seeing minimal refinancing risk and steady business out of Europe. Next up, Cowen upgrading Occidental to outperform, highlighting the company's resilient assets. And finally, Bank of America downgrading Fox to neutral, pointing to secular headwinds and a lack of near-term catalysts. Coming up, Disney reportedly ditching its metaverse plans as job cuts get underway. That conversation up next with Bowersock's Emily Hill. We are seeing layoffs continue in tech and entertainment as people think, what is the next one to experience some stress? From New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading on a day when you really see equities and bonds treading water, trying to find direction after yesterday's firming up, particularly of the S&P. You're seeing today S&P kind of clawing back some of the losses from earlier, down about 0.1%. Same deal in the NASDAQ. And you're seeing yields slightly higher as people potentially gain out what it looks like if inflation does pick back up, if you do get a Fed that doesn't cut rates quite as much as people had expected. You're seeing a bit of dollar weakness. This has been a theme anytime that there's a sigh of relief. The euro 108.30 and crude a bit softer, $72.55. One sector to watch at the open, it continues to be the banks. In less than 30 minutes, the Senate Banking Committee kicking off the first congressional hearing into the collapse of SVB and Signature Bank. Katie Greifeld joining us now with more. Katie, what are you looking for?
Well, Lisa, thankfully, it's a little bit quiet in the banking sector as we wait for those hearings to kick off. Let's start with First Republic. Still a lot of question marks over this name. It's up slightly after a big relief rally yesterday. And part of the reason it rallied so hard yesterday was you had First Citizens buying SVB. So that surged almost 54% yesterday alone. But now you can see shares down slightly as well, as are shares of Schwab and Bank of America. And even though some of the worst case fears have quieted for now, these hearings are happening against a backdrop of deposits shifting from smaller banks to bigger banks. So here you're looking at a 4-week moving average. And in the most recent reading, large banks actually saw positive deposits. And for the foreseeable future, I would bet that that H8 deposit data on Friday is going to be a top tier release. And in any case, small banks, they're lagging in the stock market as well. You're looking at KRE here, that's in orange. That's the regional banks ETF versus XLF, which tracks the broader financial sector. And as you can see from that orange line, last 3 weeks or so have left a mark.
Thank you so much, Katie. And we are also watching Alibaba after splitting into 6 separate companies. Its shares right now in the United States surging 11% on reports of these plans. We will follow that story throughout. Layoffs, meanwhile, in corporate America picking back up. Disney kickstarting its $5.5 billion savings plan with the first round of what's expected to be a total of 7,000 job cuts. Bloomberg's Isabel Lee joining us now for more. Isabel?
Hi, Lisa. Yes, it is the beginning of a 7,000 job cuts, but this isn't really a surprise because this was first announced in February by CEO Bob Iger. So the company sent out a memo on Monday saying that this is the first wave. The second wave will be around April, and the third wave, hopefully blessed, will be around summer. So Disney stocks are kind of trading flat, but for the year, it's up around 10%, and in the past 12 months, it's down around 30%. So 7,000 sounds a lot, but relative to Disney's 220,000 employees, it's really just 3.6%. And the cut comes as Hollywood tries to handle pressure from Wall Street to post profits. And Disney isn't alone. Major entertainment firms have been aggressively cutting, like Paramount Global and Comcast. Iger joined in November after leading Disney for 15 years and after his successor was fired. And his main goal was one thing, to just really improve financial performance. So this includes the uber competitive streaming business. Last year, Disney lost around $120 billion in market value, so he's really looking to change that. And since Iger becomes CEO, Disney has outperformed the S&P 500, but has still lagged the sector. But it's only the first 3 quarters of the year, so we'll see.
Isabel, thank you so much. Meanwhile, Bowersock's Emily Hill looking for a retest of the lows on the S&P, writing, quote, "We still believe the S&P will more likely than not retest June and September lows of the first half of 2023. A new low at 3,400 or even 3,200 is possible. U.S. large cap stocks are not yet undervalued. Base case is a U-shaped downturn, sort of a frown." Emily joining us now alongside Aaron Kennan, who is still with us. And Emily, from your vantage point, why has that not transpired given a banking stress, given the belief that we see with respect to lag effects finally coming to the fore?
I think there
there are two reasons for that. The first is that there is still a huge amount of liquidity in this economy. You know, our money supply is at 21 trillion. That's about 39% above what it was pre-pandemic. And so we've got an extra 6 trillion sloshing around the system. And so that is allowing asset prices to stay inflated. You know, and the second reason is that I think the market has not accepted the fact that we have undergone something of a sea change in the last 2 years, 2+ years. Every hiking cycle that we have gone through since 1991 was the last time that inflation was over 4%. All of the previous, hiking cycles in recent memory have taken place in a low inflation environment. And so I think the idea that the market is now pricing in rate cuts in the summer, that I think we've seen a huge divergence between what the market is expecting and what the Fed is ostensibly planning. So I think that is the reason. Those are the two primary reasons that U.S. large cap stocks remain inflated in price.
Well, Erin, I'd love your sense on this too, because we've seen this time and again. People try to get bearish, then they get stopped out of that, and then all of a sudden there's sort of forced buying that leads to even higher highs. How much are we going to continue to see this until something breaks more materially and more consistently?
Well, it's interesting, man. I think everyone's trying to size up where the Fed is in all this to try to predict, where rates are, where the curve is. During transitional periods in the economy, particularly in this modern day Fed where we have the SEP, the dot plots, during these transitions, the Fed has not been close to accurate. If you want to even, sort of think of this SEP as a predictive measure, which they don't like to articulate that it is, but if it isn't, then why do we have it? As we entered 2022, for example, they said year-end Fed funds would be at 1%. They were over 4%. And so, it's just not clear that we can use the Fed as indicative of where we're going. Conditions are tightening in the economy. The bond market tends to be correct by a wide margin over the course of history relative to the equity market. I'm very sensitive to that as an old bond trader, but also just looking through the historical analog. The curve's still steep. It's not positive, but even if it was positive, that tends to occur, as I mentioned earlier, as we enter a recessionary period. You look at growth stocks, they've massively outperformed value on a year-to-date basis, particularly large cap. And that seems to be indicative of the rate move that we've seen. I'm less excited about equities here. If you look at forward PE multiples, they're still well above 25 averages. If you look at equity risk premiums, they're only trading at about a 200 basis point spread. That is the earnings yield of the S&P 500 minus the 10-year Treasury yield. Usually when the dust settles and there's clarity in the market, that's closer to 300, 350 basis points. So equity risk premiums are not that attractive right now.
Just real quick though, Erin, do you agree with what we heard from Emily that we could get down to 34 or 3,200 on the S&P?
Sure, it's possible, and I think that's the recession. That's what happens when we enter a recession. We see real earnings deterioration, and markets finally react to that. We're still here sitting predicting whether or not we're going to have a recession this year, or we're going to have one next year, or we're going to have one at all, hard landing, soft landing. The market right now does not appear to be pricing in a recession, and I think there's a bit of a disconnect between the rates market and that predictive number right now, and we'll see how that plays out with the forward-looking data going forward.
Erin Kennan, thank you so much for being with us. Still with us is Emily. Turning to earnings, Walgreens and PVH are beating profit estimates, both companies highlighting their confidence in delivering a strong fiscal year ahead. Katie Greifeld back with us for more. Katie, despite all of the naysayers about people not spending, that's not what's going on right here.
Not what's going on at all. And we got a nice reminder of that this morning from both Walgreens and from PVH. Both beat expectations, like you said. PVH by a lot, and you can see that in the share reaction. PVH currently up about 16% or so. And for context, PVH is the owner of Calvin Klein and Tommy Hilfiger. And apparently people are buying denim right now because revenue came in at nearly $2.5 billion. That was a beat overall. And sales beat at both Calvin Klein and Tommy Hilfiger. And overall EPS beat by quite a bit, as you can see. Moving on, though, Walgreens EPS also came in above expectations in the second quarter. And the outlook, though, is the interesting part. As you can see, EPS is expected to be significantly higher in the fiscal third and fourth quarter, and that's boosting shares slightly, currently up about 1.6% or so, Lisa.
Katie, thank you so much. What we are seeing from PVH, we were talking about that earlier, is the best day of gains right now, going back to November of 2020. Sean Darby of Jefferies expecting earnings to drop in the next 2 quarters, writing, quote, earnings are set for their biggest decline from this point, while layoffs will accelerate. U.S. real rates are at a choking point for the economy and financial markets, and high money market fund additions suggest precautionary behavior, not deflationary. Emily Hill's still with us. Emily, how do we get from earnings to a reaction in stocks? In other words, will the earnings calls that we get in the next quarter possibly be the trigger that you're looking for?
Well, you know, it's interesting. I agree with Mike Wilson of Morgan Stanley on this. And, you know, the day of reckoning keeps getting delayed. And so I was listening to your quoting my words about the first half of 2023, and I was thinking, maybe I should delay that by a few months. But I do eventually, we are going to see the impact of all of this in earnings. It's just a question of when that's going to happen. We have to remember rates have not risen this quickly since the early 1980s. And I think that we're seeing now, as we did with, you know, as we have just seen with this banking crisis, that there are unexpected impacts of that I don't think people really understand yet. And so it's taking a while for these rate increases to reverberate through the economy, and it will impact earnings. It's just a question of when.
Well, Emily, this is really the trick, though. A lot of people have been saying this, including, as you pointed to, Mike Wilson, and just as many people say, you're not right. We look around, we see that the economy is doing okay. We see that earnings are holding in there, and stocks keep going up. How long can you stick to a call, especially if it keeps getting delayed at a time when a lot of people do expect the pain to come? We just don't know when.
Yes. Okay. Well, this is one of the fascinating things that we're seeing in this economy, and it's a puzzle. So, you know, my family was traditionally in the paper business, corrugated boxes, and so my uncle still runs a box company, you know, that's producing paper, and it's traditionally, as you probably know, a leading indicator. I call him up, which I do periodically. In his view, things are dire. You know, he thinks we're about to go into another financial crisis similar to 2008, 2009. But you go downtown in any big city, including Lawrence, Kansas, and it's packed. You can't get a parking place. You can't get a reservation in a restaurant. We really have a bifurcated economy here. And so, yes, you're right. I mean, all of these people, the bears, you know, are continuing to delay their calls. But again, we're going through a period that we haven't seen in 35 years. And so I think it takes a while for this to sink in.
What does your uncle say in terms of why he has such a negative view on what's to come? Is it just that forward-looking orders are not coming in the way that he thought, or is it just basically a feeling that he gets from the inflation and sort of how much that dampens the entrepreneurial spirit?
It's partly the latter, but there's also an enormous flood of paper. You know, paper factories are shutting down. You know, people are trying to unload it. And so that is, you know, the leading indicator, you know, someone, or I should say a leading indicator. You know, there's someone from Bloomberg that calls them every few weeks to check in and, you know, take his temperature on what's going on. So I think it's both. And, you know, this is purely anecdotal, right? This is one person in the Midwest who, you know, manufactures boxes. But I just think that, you know, we are, when you look at the manufacturing numbers, they're not great. Yet the service economy, you would think none of this was happening.
And that's been one of the hard things, yeah. It's been one of the hard parts about getting your heads around this economy, just because there is a sort of rolling recession. Emily Hill, unfortunately, we have to leave it there. Thank you so much for being with us. Coming up, corporate costs continue to be executed.
There's been a general round of cost cuts. What you're seeing is a reset of that back to some degree of reality.
That conversation coming up.
No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Of politics to the world of business. Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
There's been a general round of cost cuts. If you look at a lot of the companies that have done the cost cuts, you could very easily argue that they overhired in recent years when growth was prolific and they thought growth would continue to be prolific. And so what you're seeing is a reset of that back to some degree of reality.
Corporate America continuing to roll out cost-cutting measures, with the latest coming from McKinsey, just announcing that they are cutting 1,400 jobs this week and restructuring Disney, beginning its first wave of job cuts with the goal of eliminating 7,000 positions. CEO Bob Iger writing in a memo to staff, quote, "There will no doubt be challenges ahead as we continue building the structures and functions that will enable us to be successful moving forward." This coming amid a Wall Street Journal report of Meta's plans to lower bonus payouts for some of its employees. Bloomberg's Alex Webb and Mandeep Singh joining us now for more. Alex, I want to start with you about the restructuring at Disney. How much is this a Disney story, and how much is this a streaming story as we readjust to a new content era?
I think it's partly a streaming story. It's also partly an interest rate story. What we saw back in 2020 when Dan Loeb came in as an activist investor said, you know, cut the dividend, double down on Disney Plus, and basically reframe yourselves as a growth stock. And Disney's price to earnings ratio went from something in the order of 25 times forward earnings all the way up to 80 times forward earnings. It went above Netflix, which around that time was trading at 50 times forward earnings. What we've seen since is, and you can see here in this chart, the blue line is Netflix, the white line is Disney. What we've seen since is we've come out of the pandemic, fewer people have time to spend watching streaming, and at the same time interest rates have come up, which means that growth stocks have suffered as a consequence. You tie all those things together and you end up with Bob Iger coming back as CEO and cutting a huge number of jobs.
Alex, just quickly here, do you have a sense of where the job cuts are coming from?
Well, one thing we do know from the Wall Street Journal's reporting is they're going to be scrapping their metaverse division. It's interesting, of course, given that Meta itself rebranded from Facebook. it has not really talked about the metaverse at all in either of its two most recent earnings calls, and it has also been cutting a lot of jobs. It was a hot buzzword a year ago. Now the conversation has moved away from that and Web3 and similar topics more towards AI.
All right, Alex, thank you so much. Mandeep, from your vantage point, as you start talking about Meta, what are we seeing in terms of the social media tech giants and why those layoffs just keep coming?
I mean, from my perspective, there's something idiosyncratic about Meta simply because they've laid off almost, 25% of their workforce. And, they're still doing these bonus cuts. To me, it suggests that not only do they see top line slow down, at least for the next 2-3 years, there is question marks around the terminal value of this business simply because you don't know what the structural impact of Apple's changes or, the engagement loss that they have had to go through. And the metaverse bet that Alex alluded to, look, they're still losing $10 billion plus a year. And even after these layoffs, they continue to spend. So there is definitely a bigger risk for investors in terms of the future of the company, and that's why you see them, pull these levers on the cost side.
How much, Mandeep, are you seeing a justification for just how much the shares of Meta have rallied on cost cuts, given some of these questions around terminal value?
Yeah, so look, I mean, Meta is still a 80% gross margin business. The question is, will it remain to be 80% gross margin? If you look at Microsoft and Alphabet, they're more mid-60s now. And, for a Meta to continue to grow revenue at 80% gross margin without diversifying its revenue base, it's almost unlikely at this point of time. So you're going to see gross margin degradation, and now they're trying to offset it with cost cuts, which is what investors are happy about.
Alex and Mandeep, thank you both so much. Another tech stock we're watching this morning, Alibaba surging. China's e-commerce giant jumping the most since January after announcing its plan to split its business into 6 units. Bloomberg's Tom McKenzie joining us now. Tom, what was the rationale behind the split?
Lisa, this is the biggest restructuring for Alibaba since its founding in 1999. The rationale, two fronts, really, and you would assume that the government, the Communist Party, has given this move their blessing. For the government, this ticks two boxes. One, it addresses their concerns about the monopolistic behavior of Alibaba as they view it. Number two, it makes a play at trying to convince private enterprise, private business in China that the Communist Party has got their back now and that they support that. Because what you're going to see, these 6 units spun out of Alibaba around logistics, around e-commerce, around cloud, around media and entertainment. They will then be able to go and raise their own funds. And the CEO of the overriding group has made it clear, Daniel Zhang, that they can also look to IPOs. So that is what is being suggested and what is going to happen as a result of these restructuring. The other question is, to what extent is this a template for some of the other big tech giants out there in China?
And that's a big question right now, Tom, especially as you start to see an increasing consolidation in Beijing. And meanwhile, for some of the sector price action this morning, let's get to Bloomberg's Katie Greifeld. Katie, what's going on out there?
Well, it's a quiet day overall. If you look at the S&P 500, down about 0.2%. If you look under the hood, it's a little bit more interesting. Right now, you have 7 sectors in the green. Industrials leading the way. They're up about 0.5%. Consumer staples, too, seeing a bit, as is materials. So looks a little bit defensive to me. Then you look at the downside. You have communication services leading the way lower, as is big tech. Remember, these had been the outperformers. Not so much this week. Both of those sectors down for a second straight day.
Thank you so much, Katie. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. As you can tell, we are seeing sort of a range-bound market trying to find some direction, although the NASDAQ continuing its underperformance after yesterday's as well. Suddenly a reversal of the trend we've seen this year.
Our conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
This is Bloomberg.
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Taking a look at markets, the theme this week perhaps is the underperformance of the NASDAQ, down 0.6% versus just a 0.1% decline on the S&P. This really driven by this feeling that perhaps we could see some increase in rates, perhaps beyond what people thought, or at least keep them higher for longer. You're seeing the two-year yields above 4% after being as low as 3.5% not that long ago. 10-year yields at 3.5% currently. A bit of dollar weakness as people readjust to where we are post some of the banking stresses. Time now for the trading diary you need to be watching this week. 2 days of bank hearings on Capitol Hill kicking off at the top of the hour. President Biden discussing his economic agenda at 2:30 Eastern. U.S. GDP, another round of jobless claims, all coming on Thursday. Plus, of course, Fed speak coming from Kashkari, Barkin, and Collins, followed by Williams, Waller, and Cook on Friday, and closing out the week with the University of Michigan sentiment survey, as well as core PCE, that key inflation metric that the Federal Reserve typically does look at. Right now, those hearings are beginning in Washington, D.C., as people get seated and prepare to do an autopsy of what happened on March 8th and in the weeks after. This was Countdown to the Open. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe.
Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually
part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because